Good afternoon, everybody, and welcome back to those who are with us this morning for the International Financial Centre Summit, and welcome to those who have just joined us, and of course to our virtual attendees around the world who are tuning in as we speak. The event has been live streamed and there are recordings available later. Once again, just a very quick thank you to the City Week Board of Patrons, to our partners, the Department of Business and Trade, the City of London Corporation, UK Finance and the City UK, and to all our many sponsors and supporters without whose help today's event would not have come to fruition. Whilst this morning we considered some of the macro reasons for the current dynamics in international finance and how they're affecting London or other international financial centres, this afternoon we're turning our attention more specifically to the capital markets, both in, well, with particular reference perhaps to the UK and Europe. And here in the UK, the government has been actively reforming the capital markets. Only last week in the King's speech, there was a new financial services bill announced, and last month there was the Pension Schemes Act 2026, the Financial Service and Market Act 2023, there have been 31 measures in the Edinburgh reforms from 2022 and another 18 measures in the Leeds reforms from last year. Not to mention the Financial Services Growth and Competitiveness Strategy published last year. So all in all, around 90 separate initiatives. But the question is that enough in a fiercely competitive world? And if not, what more perhaps needs to be done? And of course, in Europe, the European Capital Markets Union project has been at best sluggish. So what will it take to change that? And what is the potential of the EU Savings and Investments Union to catalyse that process? So to address these and other related issues, we have assembled an exceptional panel of speakers this afternoon. For further information on this, do have a look at our app. And also, if you could bear in mind, there is a delegate questionnaire on your tables. Constructive criticism is always extremely helpful. So let's get started. It's my pleasure to introduce our chair for the afternoon, Bob Wigley, Chair of UK Finance, and one of the leading lights of the UK financial services industry and one of its most influential figures. So I don't think I need to give any further introduction. Bob, over to you.
Well, good afternoon, everybody, and welcome to this afternoon's conference. I think welcome back in the case of some of you who might have been here this morning. I'm Bob Wigley, Chairman of UK Finance, the industry body that represents banking and finance in the UK, 300 members from HSBC down to Monzo, Starling, Revolut, with all the payments companies, asset-backed lenders and mutuals in between. When the Chancellor wrote Christmas before last to the regulators, asking for them to come up with ideas for how the UK government could roll back a regulation post-Brexit to encourage the development of financial services in the UK, the letters that initially appeared I thought were a little disappointing. And so I challenged the team at UK Finance to come up with some ideas, which we did. And that was submitted to the government last year, having consulted with 150 CEOs amongst our members. And we called it the UK Finance Plan for Growth. It actually addressed both growth and financial inclusion. We just, by the way, submitted an update to it, if you're interested, on our website last week, which will take the work that we started a year ago forward. But I wanted to just cover quickly what we said at very high level before I introduce the panel. And I'm going to do this super fast, but I think it puts the conversations that we're having this afternoon on specific subjects in a wider context. I should say, first of all, I'm very bullish about the UK, and that's probably why Maurice asked me to do this job this afternoon. I've always been a bull of the UK, and you could criticise this government for many things if you wanted, but the one thing you can't criticise the Chancellor for is her attempt to improve financial services regulation. She's actually achieved more, I think, in the last 2 years than we'd seen for a very long time. So Morris mentioned, Mansion House 2 years ago. He mentioned the government's regulatory action plan. He didn't mention, but maybe should have done, the government's industrial strategy. That's probably the best, most detailed plan that I've seen in my working lifetime. There was then Mansion House, the Leeds reforms, the Mansion House Accord, and HMT's financial services growth and competitive strategies. There's a lot going on. And I think in our plan for growth, we list about 60, actually, individual measures which we're either working with the government to implement or working on the government to persuade to announce and then implement. I think about 40 of them are on track, work in progress. Some of them we haven't quite got there yet, but we're on it. So what did we say in our plan? Very briefly, we said 3 things. We want a pro-growth operating environment for our sector. We want a financial sector that is fit for the future. And we want the government to take steps to unlock financial services for people, businesses, and society. So within the first category, ensuring a pro-growth operating environment for our sector, that included things like reform of the FOS, which is well in train, and in the King's speech, the final steps to achieve what we need there were announced. The drawback on the consumer duty to focus it on wholesale, not retail, which I think was never intended. Sorry, the other way around, retail, not wholesale, which I think was never intended. This year, it's about reviewing capital in the system. So the FPC have announced their review of capital requirements for banks. We've made a submission with detailed suggestions of how the bank can both reduce the base level of capital, adjust risk weightings, stop the overlapping of buffers, so we can reduce the amount of capital in the system with the aim of freeing up capital to lend to the real economy in terms of mortgages for people to buy houses, corporate and SME lending. So that's the big focus this year. And the bank actually announced this morning, you probably saw a review of the rules around ring fencing, again with the aim of freeing up capital to lend to the real economy. Digitalization and digital tokenization, we're going to talk about that this afternoon, so that's a big one, massive opportunity. I think this government has one thing it could do to put London back on the front foot. It would be to make the UK the leader in digital tokenization of real-world assets. We are making progress. We now have a digital champion. He is going to be creating a roadmap with our support and the support of others over the next few months to try and put London back on the map. And just by way of clarity, we have a slightly different objective from the States. So although we have this digital assets task force with the States that is looking at how we can do things in collaboration with the US, I think they're more focused on stable coins. They're not going to have electronic identity under a Republican leadership. They're not going to have a CBDC. We are going to have great British tokenized deposits, probably faster. So the UK can steal a march here, and we must seize that opportunity. We need to push through the changes that are going in terms of the payments infrastructure in the UK. It used to lead the world, it now is behind. There's a new payments vision, we must make sure that's put in place. There are some specific things we're working on with the government around SME lending, removing the cap currently put on guarantees for the business growth loans which are made to SMEs through banks. And then in terms of sustainable finance, where again, classically the UK leads the world and I think can lead it further. Going forward, what does our second sort of update on the plan for growth focus on? Well, it talks about policy continuity. We've had a lot of chopping and changing. We need to keep going on this path, but we've got big concern with the amount of political change that might be about to happen, that if we had a different chancellor, we could lose focus. So I'm hoping that we maintain that continuity on this rollback of regulation. Lots of speculation about more taxes on the financial services sector. That would be deeply unhelpful at this particular point when we've got real momentum. And then I think fraud is the final area where, sadly, the UK leads the world, and we need to fix that. That really is about better collaboration with the telecoms and big tech companies, and there's a massive amount of work to do there, and we are working closely with the government through the economic crime strategy to try and address that. So I hope that's helpful just to give you a little bit of a sort of an overview before we get into the nitty-gritty on particular areas. I'll stop there. My job now really is just to introduce James Wootton, who is the Global Head of Equity Capital Markets for London for Linklaters, who's leading the first panel. James is a corporate partner at Linklaters. who has been instructed on both sides of IPOs, led all sorts of interesting equity capital markets transactions. He also advises on general corporate matters, including private and public M&A transactions, and is recognised for his expertise advising a number of the major investment banks. With that, let me hand over to James Wood.
Thank you, and good afternoon, everybody. A great privilege to be here, this very, very important event, and in particular, a privilege to be moderating a panel with such distinguished representatives of companies that really embody what it is to be a great British growth story, which is fantastic to see. So, great privilege to introduce Lisa Jacobs, the Chief Executive of Funding Circle, Declan Ferguson, CFO of the Starling Group, Justin Bassini, the co-founder and CEO of ClearScore, and Richard Davis, the CEO of Alaka Bank. I'm sure those businesses need no introduction to you. So we're going to hear a lot today and on the panel about things we could do better as an ecosystem. But I make no apology for starting on what I hope is a positive note, which is to say that each of your companies has grown to a fantastic degree out of the UK ecosystem. So I'm just going to start by asking, what is it that we do well? What is the start? What are the foundations that we have to build on? And I'm going to put that question first to Justin, if that's okay.
Yeah, thanks. Thanks, James. Very nice to be with you today. Yeah, I'm glad we started here. You know, I think the UK still represents a fantastic place. You know, I'm the founder of my company, and, 11 years ago when I founded the business, and through the last decade, we've really seen the benefits of being a UK startup, scale-up, and now one that really is part of UK financial credit. And I'd put four things really there. I think regulation and the fact that we have a really engaged regulator, and obviously all of us will complain about regulation hugely. I'm sure many of you will as well. But the fact that we have Nikhil here, we have engagement with Nikhil, I think is really important. You know, I operate in the UK, South Africa, Australia, New Zealand, and Canada, and I can tell you that the UK is the most engaged regulator. They really want to understand, how they can help scale-ups and how they can help the next generation of companies. The two other things I would put in, the second is consumer openness to trying new things. So this is something which I don't think gets particularly a lot of coverage, but the UK consumer is very open to digital and is very open to trying new brands. If you look at the penetration of things like neobanks, neobanks have really struggled in the US, and that's partially because the US consumer still looks to very established brands, whereas in the UK, there is a real openness. And then the third area I would say is digital adoption and smart data. And so, the legislative infrastructure that we have in the UK has really helped my company to unlock data and empower consumers with that data. With open banking, where we've led the world, I think that is a really strong, contribution. And I think with some of the smart data that probably will happen over the next 10 years, or I hope it will, the access to data and consumer empowerment, I think, will be really important and will be a basis for future success of our companies and I think other companies going forward.
Thank you. Richard, is that consistent with your experience of growing company in the UK?
Yeah, no, I'd agree with those points that Justin makes. I think just to build on that, I'd probably add a couple more. So I think UK, and particularly some cities in the UK, London, Edinburgh, Manchester, have got pretty high density of financial services ecosystems. So for fintech in particular, I think that's been pretty conducive to people having gained some domain experience and then starting their own company from there. And then alongside that, I do think the EIS, VCT in the UK has been quite a powerful catalyst. I'm a fairly active angel investor myself, and I think EIS is very supportive of people that perhaps have made some money in the UK startup ecosystem, then reinvesting that back into new ideas. So I think some big strengths there.
Thank you. And obviously what we're here to talk about specifically today is the role that the capital markets can play in that growth story. So the venture capital, private equity, angel funding ecosystem is sort of fairly well understood. The question is, how do we translate that into what the role an IPO can play, a London listing can play, and the public markets can play. And to get a couple of perspectives on that, I'm going to start with Lisa, because the Funding Circle have been through that journey. It'd be good to know what your thoughts on the IPO as a stage in the financing of a company.
Yeah, so Funding Circle, we're listed in FTSE 250, and we listed in 2018. So quite a long time ago now relative to where we are. But I think I'd echo what both Justin and Richard said in terms of the UK being this really great place. And the other thing I would add on top of that is thanks to all these great initiatives that we have, we've got a really good magnet for talent here in the UK, and that has grown up. And you see the fintech industry in particular has been a really great success story, and we've been able to attract that talent internationally but also homegrown, and therefore we've got a number of businesses that have been started actually by immigrants from across fintech. I think it's probably about 50% of the unicorns that sit on the Unicorn Council are founders outside of the UK. I think that's really phenomenal, and it shows the power of that ecosystem. And sometimes we think that we're doing really badly relative to other people, but actually that just shows the power that we've got. So when we listed in 2018, we were really proud to be listing here in the UK. We're a British business that we very much back SMEs across the whole of the UK. So for us, it was really natural to be listed here in London. And as I was saying, it was now 8 years ago. So since then, I think actually the environment's got much better. There's been a number of regulatory reforms that have been spoken to and enacted by people within this room to make the UK continue to be a really attractive place for businesses to list. On the other hand, we've had some negatives in terms of the number of businesses on the LSE has decreased significantly over the last several years, as has the amount of UK pension money coming into UK equities. So I think all the work that is being done around Mansion House reforms are really important. Private markets, but also the public markets, and making sure that we are continuing to support these great UK success stories. But also, for me, the biggest unlock is going to be that momentum. We talked about ecosystem in the private sector, the momentum of bringing on some more really great businesses, and we have a huge amount of them here in the UK. There's 3 others on the panel today. Will really unlock that broader ecosystem of analyst coverage, of investors who are used to seeing tech businesses and want to back really strong growth businesses alongside some of the rest of the income stocks that they've got, and that broader broker coverage as well across the market. So for me, I think there's been a huge amount of change. I think the London market is really well set up, and continuing to gain that momentum will be really important.
Thanks, Lisa. And Declan, so in that context, and when you think about the possibility of an IPO in some point in the Starling journey, what is it that excites you? What are the things that scare you about things that you've seen in the market?
Yeah, thanks, Jamie. Look, for us, we've raised 700 million for the business now over the last 9 years. I actually sat back and looked at the cap table the other day, and more than 80% of our shareholders are international, and actually most of those international shareholders are US-based. So that kind of tells you something about the pools of capital that are backing these types of British success stories. For us, we would love to, at some point list the business. I think that is a natural trajectory for the business, probably within the next 2 to 3 years. We are most focused right now on building value across both sides of the Atlantic. So we have our engine business where we're now live in 4 countries, but where we built, grew and developed the business over the last 10 years has been in the UK. And we are kind of a byproduct, if you like, of the very favourable regulatory environment we've had here. And I think all of the reforms that the rest of the panel have talked about will only add to that. So I think the case for a UK IPO is becoming stronger, but I think we need to see more throughput coming through. The plumbing's in place, if you like, but we haven't seen the kind of throughput yet of kind of landmark IPOs.
Thank you. And that leads nicely on to the question of when we assess the London market, and there's been a lot of analysis about the London market that's underpinned the recent changes. A lot of it is done by comparison with New York on the one hand and continental Europe, their exchanges on the other. So Richard, turning back to you, like how do you think about, when you, again, thinking about a potential IPO, what factors might come through your mind as to where to list and what difference the jurisdiction of the listing could make?
Yeah, so we're not sort of actively working on any form of listing at the moment, and I probably have the benefit of watching some others go first, which is helpful. But we are very actively working on expanding internationally. So We're currently working on entering Northern Europe, securing a bank license there, and plan to have presence across multiple countries. And I guess if you are international, you probably have more considerations then around where you may list. I mean, I think UK is probably the most natural home, given the current scale of the business is all very much UK. But Stockholm, Nasdaq's quite effective, and there's clearly also the US. So not something we've given a lot of active thought to, but you clearly do get people start to give you advice, even if it's not necessarily prompted. So there clearly are quite a few considerations in terms of market liquidity, where I think you've definitely seen some stocks struggle in the US, right, that have perhaps gone there for valuation, but found that they're not really got sufficient market cap for interest, and they haven't got a domestic business, so they're not attracting domestic investors. So US perhaps can be attractive, but probably isn't quite the sort of golden goose that it's always made out to be. So yeah, early days for us, but it does seem there are quite significant differences there to consider across jurisdictions, and one we will think about carefully if we ever do initiate a listing.
And Justin, actually speaking as a founder of your business, one of the things that we hear a lot is the sort of different environment for founders and entrepreneurs in the US. Is that something that do you look across the channel at your peers who founded businesses and think there are things over there that you'd like to see more of here?
Yeah, I mean, I think the appetite for growth and risk and reward is very different in the UK, mostly from institutional investors. You know, there's much more openness to risk in the US. Similar to Declan, much of my investment has come from the US. I would love to have more UK investors, but the reality is when you look at the companies that we run, they are growth companies, and so therefore that the money that might be returned in terms of gross profitability needs to be invested in taking the opportunity that all of our companies have created. And I think that possibly is not as well understood or valued in the UK as it is in other jurisdictions. Having said that, you know, if I think about where we might, if we were to ever IPO, it would be in London. Primarily that's because I don't have a US business, and the size and scale of my business, I would be a minnow in the US, whereas in the UK, I would get attention, I would get seen. You know, I was with Nasdaq maybe about 6 months ago, and I was very struck by the two salesmen that were trying to sell us. And, they said, if you're 5 to 10 billion in market capitalization, we refer to you as a sort of tweener company. If you're over 10 billion to 20 billion, that's when the market really starts to come up. And if you're over 20 billion in market capitalization, that's when the market really works for you. Now, there aren't many UK fintech scale-ups that can attract that level of market capitalization. Maybe in a few years we will, but at the moment, I think the UK is the obvious choice for most fintechs.
So then turning to, obviously there's been a huge amount of regulatory reform, all of it broadly deregulatory over the last few years. So but just starting on what I think of as the demand side of capital. So what is there more in terms of regulation that we could do to make life easier, to make it more attractive, to make life easier to be a listed company, to get listed and to be a listed company? Lisa, I'm going to put that to you as a CEO of a listed company. What is there more that the regulators can do to free up a bit more appetite for growth in the way that Justin was talking about?
Yeah, I mean, I would defer as well to those on the panel who are pre this and thinking about this, but I actually think there's been a really good job done over the last several years in deregulating, as you say, and making the UK just as attractive, if not more attractive, from a regulatory position than other jurisdictions for listing. So I'm not sure how much more there is to do from a regulatory position versus actually getting that momentum. I don't know if what would it take for those people who are on the cusp at the moment of going to actually list here in the UK, because I think that's what really will trigger a shift, because then you get the whole ecosystem starting to work much better together. So I don't know, others on the panel may disagree, but I actually think we're in a really good spot from the regulatory environment for listings here in the UK.
And maybe just back to you, Justin, just if we try and broaden it out from the IPO process, the listing rules, all those things that we deal with day to day, into other areas of the legal landscape, so call it, tax, employment reforms, without getting into the details of anything too political, are there things that we can do at a macro level to make it a better place to run businesses as a business owner?
Yes. If you look at some of the changes that have happened over the last, couple of years, it's a bit of a mixed bag. Many of the reforms which, Bob referred to are very, very welcome. But it is more expensive to employ people now. The tax incentives have changed a little bit, like things that many of us have talked about, sort of EMI and things like that, which allow us to incentivize employees. There have been positive changes, but the positive changes don't affect any of our companies because we're too big. And so I think, I've said to government many times, I think they're on the right trajectory. I think they understand what they need to do. They just need to go further. So, the fact that there is still taxation on share trading in the UK. Now, we have a tax break for people who, that for the next 3 years, that moratorium, if you float, it needs to be broader than that, right? And we need to really back and create an environment where companies like ours are going to go after it, and it is going to unlock institutional investment into our companies and retail investment into our companies. And so I think we're doing much of the right thing. We just need more of it.
I'd add in the broader market as well, it's also the level of stability that there is. We support SMEs in lending, and they're the same as the types of decisions that we make in our businesses. Like, what is going to cause you to invest in growth in your business? It's having certainty over where policy is going to lie over the coming months and years to have that confidence to invest. And we've seen, we felt like we were starting to see a bit more certainty, but obviously over the last week or so, that has taken a bit of a turn. And so having that it actually has a real impact in terms of business decisions, business confidence, business investment, and ultimately growth in the UK.
Yeah, and it's always struck me that actually the fact that we have an extremely encouraging and useful tax regime to incentivize early stage investment is one of the reasons why we have this incredibly vibrant startup ecosystem. But actually, you're right that those tax incentives start to drop away once you're deemed to have broad enough shoulders.
It's like tall proppy syndrome for taxation on entrepreneurs. Yeah, it's like, have a go, start your business, super easy to do it. You can raise money from people like Richard. I'm sure he'll be a fantastic seed investor, EIS, all of that sort of stuff. But, then when you have a modicum of success, basically everything is at that point, there's no real further incentives. Yeah. And we've got to change that, because really it's at that point, yes, you've got to have guts as a founder to set your company up, but you also need to continue to have guts over 10, 15, 20 years. It's that compounding of growth that is how you create consequential global companies out of the UK, which is absolutely what we need to do. And that's the challenge for all of us on this stage, and we need the support of government and the regulator to allow us to do that.
So you've touched on some really important sort of macro cultural factors, which I'm going to come back to in a minute. But before I get there, all the reforms that we've talked about, a lot of them have been the demand side of capital. So what is it to make it better for you as businesses? But it strikes me that there's a big part, the next piece of the puzzle is about capital, and Bob's referred to this already. But Declan, I'll ask you, what would you like to see in terms of what could we do to our investment infrastructure in the country to encourage more inflows of capital, both domestic capital and international capital?
Yeah, I think I'd say we have almost too much international capital flow, which is kind of drowning out maybe some of the domestic capital. I go to a conference a month and speak to 10 to 15 investors, and I'd say 80 to 90% of them are US or international based, which probably reflects the statement I made earlier about, the composition of our current cap table. We have one pension fund on our cap table today, but what strikes me is when I go and have those conversations, kind of typically one-on-one, three-on-one type formats, there is very, very limited representation from kind of, British pension funds. So we need to find a way for those pools of capital, and they are significant pools of capital, to have the skills and capability to be in the room trying to catch these companies kind of pre-growth, pre-IPO stage, because that will help them to generate returns. And there is a lot of capital tied up there that can be useful to companies like Starling and many of the other panelists here.
And I'm actually going to open this to the whole panel, but what role do you think UK retail investment plays in this story. So that is both through our pensions and the institutions, but also as individual retail investors. I mean, Richard, do you want to say that we hear about the amazing the pools of capital that are being used, all this money sitting in bank accounts and so on. Is that a big part of the story?
I think it is. So definitely pension fund money is clearly an obvious pool that's a lot of work's been done on, a lot of announcements around. I guess the actual reality of deployment seems to be lagging quite a lot behind that. Retail, it's a little bit, there's not enough business investments in the UK economy. There's not enough retail investments in shares in the UK. I think Lisa was saying the point, we're quite risk averse as a society. And that's actually pretty damaging for you economically in the long run. It's damaging for us in terms of business productivity, because if you don't invest, you don't get productivity growth. And it's damaging for you with your personal money. If you put it into cash, you will get a lower return than equities in the long run. And so feels like it's almost like a risk culture, a celebration of risk-taking that's needed, and awareness that actually by taking sensible risks every day, every month, you accumulate far more capital in the long run than if you just try and sit on your cash.
And so how do we then, as a country and as an economy, how do we change that? So let's start. I'm starting with just the encouraging people into retail investment.
So I think that it's a hard challenge, but I've been really glad to see that financial education is now going to be on schools' curriculum, because I think it does need to start that early. And obviously, I know 20 years ago I tried with the Child Trust Fund and to encourage that investment. It's a shame that that wasn't coupled, I think, at that time with that broader financial investment. So I do think this starts in terms of how do we educate our children, and how do we create that that dream, that vision of being an entrepreneur, celebrating those people who are creating jobs across the UK. I mean, I get to sit with great people like this, but I also get to go and meet a number of small businesses who are borrowing through Funding Circle. And these people are amazing at what they do. They're every day grafting, taking risk, employing people, and being really important growth drivers in their own communities. But I think there's been a bit of a gap that we're almost nervous to celebrate these people who are doing really great things in their community, who are doing really great things on a national stage, international stage, and celebrate what they are doing, but also draw that link between what they're doing and the shared prosperity that means across the country. Because I think there is this disconnect between business and what's happening across the country, which I think is a difficult one to solve, but I do think it starts with that education in school, encouragement of entrepreneurship, encouragement of financial education more broadly.
I mean, I think this sort of risk aversion is hardwired into the system. So, you know, I have a 22-year-old son. He's just started work. He's making decisions about his pension. He's not a fool. He comes to me and he says, now I'm being asked to make a decision on risk allocation. And I don't want to be really risky, but I don't want to be like really unrisky. So I'll choose the middle one. This guy's 22 years old, right? He should be fully exposed to equities. So it's this sort of risk aversion, this protection mindset, it's almost paternalistic, has been created over the last 20, 30 years. I don't think, you know, in the 80s it started to break down. You know, I remember my dad who's a teacher, you know, buying shares in British Gas and British Telecom for the first time. He'd never bought shares, and he saw that link to household prosperity and to all of the work that we all do in this room, and his own his own family's, income and prosperity. We've got to get back to that. And you know, not to overstate it, I really worry about the legitimacy of capitalism. You know, basically I spend a lot of time with normal consumers up and down the country, and many of them feel that, you know, building businesses is just for fat cats, it's just for CEOs to make a load of money, bankers, lawyers to make a load of money. And we've got to get back to them understanding that all of the work that we do in this room, all of the growth, is returned to them through pension funds, through retail investment. And if I've got any hope, that's what I hope happens over the next 10 years.
And more specifically, what can we do so that what role do we all have? There's a role that feels to me for central government in setting the tone of that narrative. There's also a role for the media. I think one of the slightly depressing surveys that you ask most people in the street to name entrepreneurs, and the names that come up, you get Alan Sugar and you get Richard Branson. Those are the names that come up, and it's like, I think we've given the incredible amount of wealth creation out of this country over the last 20 years. Those should not be the names that people name, or the only names that people name in any case. So what about the big cultural shift to celebrating wealth creation also has the other side of it, which is that how do we behave as a nation when things go wrong? If people make risk, obviously means risk. It doesn't always go right, but how do we get to a position where we make people understand it's okay if prices go down as well as going up? I don't know if anyone wants to have a view on that. Declan?
Yeah, I mean, I think you have to pivot the story away. The founder story is super important, right? And we need to do a bit more of that a la the US. I think Justin's spot on with that. But if you kind of want to play to the hearts and minds of the British public, I think it's about job creationism, wealth and prosperity more generally. Most of us here have built companies that employ multi-thousands of people. So we have built and created jobs in the UK. And I think that is a big part of the story that sometimes goes missing. When you talk about that kind of older generation of entrepreneurs, if you add up collectively over the last 10 to 15 years, the amount of businesses that have been grown in a relatively small part of the world and then taken international in lots of our cases as well, and the collective jobs and wealth they've created, I think that message often doesn't land with people.
So we started on a positive note, and I'm going to try and end on one as well. I'm going to ask you, looking ahead, if each of you could have Prime Minister for a day, Chancellor for a day, head of the FCA for a day, whatever you want to be, what's the one thing that you think we could do as a nation which would deliver more on growth, in particular reference to the capital markets, but anything that you could see? I'm going to start with Richard.
I think it has to be how we harness pension money for private, but also for public markets. It's very stark how the UK is an outlier there in terms of proportion of money that's in the UK domestic equity markets or private equity in the UK compared to, I think, almost every other country in Europe. So lots of work going on, to say, but it doesn't really feel like it's actually translated into sufficient impact so far. So that is, I think, the critical one for me.
Thank you. Justin?
Is this a practical thing or a magic wand thing?
I'll give you two.
Well, my magic wand thing would be if I could help everybody understand that, it's to Lisa's point, over a 10, 15, 20-year period, how investments in growth companies compounds over time. And so, the mentality, so that if I could let everybody understand that would be my magic wand thing. I suppose the practical thing would be, every single investment advert that you ever see talks about the downside risk and not the missed opportunity that you are going to be poorer if you don't make these smart, sensible decisions and if you keep your money in cash. And so I think there's some work to do there.
Lisa?
I would echo the magic wand one, and it would be nice if the Child Trust Fund, you could combine that with financial education, and then everyone at age 18 gets this big lump sum that's grown and really deeply understands it. In terms of practicalities, thinking about the UK market specifically, I'd do what it takes to get the next 3 growth tech businesses listed here, and then let them take the momentum forward.
I'm going to take the liberty of doing 2, actually. Look, I think there's one for kind of galvanizing stock investment in retail investors. Why can't we give them some kind of incentive? So take people, some kind of tax break or incentive for investing in UK stocks for the first time. And the second, we kind of touched on it earlier around share schemes in companies, and how do you, now that companies stay private for longer, how do we find a way to kind of galvanize the next stage of company growth? So lots of us here have been private, I think, for 10 years, excluding kind of Funding Circle. And typically when you raise money, you would raise your Series A, your Series B, maybe a C, and then you'd go public. Well, we've got people raising Series H rounds now, right? But how do we find a way for management teams and boards to give tax-effective structures to let people take risk in the next stage of growing a company? Because that's how you grow a 5 billion company, to Justin's point earlier, to a 50 billion to a 100 billion pound company, and that's how they're achieving outside of the UK.
Thank you. So some fantastic insights there, and I hope you all agree there's lots of reasons to be positive. More to do, but lots to play for. So many thanks to the panel.
Well, a very good discussion, I thought, and they honed in on one sort of central point, which is that we've allowed a governance and risk system to build up in the pensions industry that, the way I put it when I'm talking privately, is we prefer to give people the smallest possible pension with certainty rather than the largest possible pension with a bit of uncertainty. And that, when you think that my children, for example, who have money in DC schemes, which have no investments whatsoever in growth assets, they're investing on a 40-year horizon. It should be almost illegal for that to be possible. So we have to fix this attitude to risk and get people's focus back on the best place to put your investments at sensible cost rather than simply eliminating risk and minimizing fees. So with that, let's get on to the second panel, which is going to talk a little bit more about the ongoing reform, assessing progress to date and then looking at what's come next, and who better to lead that than Mark Austin, who over the last, I guess, 10 years, Mark has been at the centre of designing much of what's already happened and no doubt some of what's to come. I won't give you the full CV, but if we go back a little while, he advised Lord Hill on the UK listings review. He was asked by the Chancellor to be the independent chair of the UK secondary capital raising review. He sits on CMIT, which no doubt they will talk about on the panel, and the HMT's Digitalisation Task Force, is a member and former chair of the FCA's Listing Authority Advisory Panel. So no one better, I think, to talk to you about this than Mark. And like me, he is a strong advocate for the strength of the UK and how it can be even better with a little further change. So Mark, welcome to the stage.
Fantastic. Well, thank you, Bob. Good afternoon, everybody. It's a real pleasure to be here, so thank you for having us. We're going to build on what you heard in that previous panel, and you are going to find us, as Bob just talked about, being very Tiggerish about the UK. We can sometimes, I think, be a bit too, as Brits, Eeyore-ish about things, a little bit too much, oh, it's raining, wake up in the morning, oh, it's raining again, rather than, oh, well, it's going to be sunny at 11 o'clock. So we're going to inject positivity, look on the positive side of things, because we all on this panel firmly believe that, and also just probably build a bit on what that previous panel was talking about in terms of a bit of the nuts and bolts of what's happened, why it's happened, where it's going, give a bit of an international perspective as well. And before we kick off, I'll just ask everyone on the panel to go down and just introduce themselves so you know who they all are. Some of them need no introduction, like Julia.
Julia Hoggett, CEO of the London Stock Exchange, Chair of CMIT, and Head of Digital and Securities Markets for LSEG.
I'm Sian Hurrell. I'm co-CEO of RBC UK and Head of Capital Markets in Europe for Royal Bank of Canada.
Good afternoon. I'm Anne Prendergast, Head of EMEA for State Street Investment Management and Chair of the Investment Association.
Hi, John Wilkinson. I co-head ECM origination at Goldman Sachs, and within that I specialise predominantly in the UK market.
Great. So you can see we've got a range of perspectives here, and a slightly different take on what we've been doing for the last 6 or so years in the UK from the previous panel. I thought we'd start first with Julia. So Julia and I have been treading this reform journey for 6 years or so now together, a bit longer. Julia is one of the prime movers upon everything that's happened in the state, in the reform of the markets here. She chairs CMIT, as she just said, and is CEO of LSE PLC, amongst other things. Julia, why don't you just sort of try in sort of a few minutes to contextualise the journey of the last 6 years, why it happened and where we are and what still needs to be focused on?
Yes, so when Mark said you can summarise CMIT's work in 4 minutes, can't you? I nearly had a heart attack. So let me try and just articulate the journey we've been on. It started, and Bob mentioned this as well, with the Hill Review. And the Hill Review was brilliant because actually it stimulated the conversation that needed to be had about our listing rules. And there were some parts of the ecosystem who were actually saying, nothing to see here, move along, we don't need to change it. But as soon as you put a straw man out there that people could engage with, actually what we've ultimately ended up with in the reform of our listing rules goes far further than Lord Hill initially proposed. And when I came to the exchange, I mean, the way I describe it is that we don't set the listing rules, we don't set company formation rates, we don't set rules for pension funds, insurance companies, retail investing, the advice banks give their clients, any of that, but we're actually blamed for the efficacy of all of it. So we can either say not us gov, or we can step in and be the biggest convener of the conversation about the shape of our markets, which is what through CMIT we have sought to do. And that's about bringing all sides of the ecosystem together, private companies, private investors, public investors, to understand how every part of the market experiences the market and figure out how we can make it work as well as possible. To do two things. Create an environment in the UK where great companies can start, grow, scale, and stay here, and make sure our capital markets have the best possible assets for our policyholders, our pensioners, and our savers to have enough money for life events and old age. So the entirety of the reform agenda and where we have sought to lean into things that were already happening and to create some structure and vision around it has been through that lens. How do we get back to the core purpose of what our capital markets are for? It's actually a lot of what the previous panel said. It's actually financing real businesses to make real things, employ real people, pay real taxes, create real returns that those assets can then result in better results for our pensioners and our savers for. That's the thing that we've so abstracted our markets that we've forgotten the core purpose of them. And the entire reform agenda since has been focused on that. And we had an agenda initially that we described as 5 fingers and a glove. First was the quality of our primary and secondary capital raising rules, because they really hadn't been changed in a generation. The FCA deserves a huge amount of credit for all of the reforms that have taken place there. I think John or Wilco can probably go into even more detail. But I think it's actually now we can put our listing rules side by side next to any other market and say we've got the most compelling rules. And we have re-enfranchised retail to actually be able to buy regulated assets, unlike other jurisdictions. The second finger was the availability of high-quality sell-side research, how we make sure that the unbundling rules that had impacted the availability of that research were reversed. Rachel Kent did her review and recommended it was reversed, and 2 weeks after the FCA made the first listing rule changes, they reversed unbundling as well. That's still harder to put that genie back in the bottle, but at least from a regulatory point of view, we've done it. The next was to stimulate the conversation about the availability of domestic risk capital. That was a theme in the previous panel as well. We have no shortage of capital in this country. We have no shortage of great companies. We have a shortage of capital we spend on ourselves and a shortage of capital that's structured as risk capital. And therefore, we really needed to stimulate that conversation. We've seen through Jeremy Hunt and Rachel Reeves some pretty radical restructuring of our pensions so that we're not kind of focused just on lowest cost, but we're focused on the net return. And there is still a lot more to do there, and we recognise that. But we've also focused on a multi-year programme to re-enfranchise retail. Consequence of losing IFAs from the high street and regulatory reform over the last 20 years that actually made it harder for retail to access regulated assets, and an ISA regime that gave people a tax break for keeping all their money in cash, we had actually gradually disenfranchised, and a whole lot of risk warnings that said you could lose all your money if you invest in a piece of equity or fixed income, but not if you invest in crypto. Then we had created an environment that had disenfranchised retail. So over the last several years, the FCA has fixed retail's access to regulated assets. They have then done the advice guidance boundary review to support that access to advice. They have worked with the IA to change the risk warning language to not give people the fear of God whenever they read one of those statements. You've seen what the Chancellor's done on ISAs, and then we kicked off the Savvy Squirrel campaign earlier this year to have a long-term investment by 20 different providers of financial services products to retail to basically undo the cultural effects of the previous 20 years. So that has been a very structured and deliberate program that all fits together. The fourth finger was corporate governance, stewardship, and REM. Richard Moriarty came in as a new CEO of the FRC, made it very clear that corporate governance regime was comply or explain, and wrote a brilliant piece in the FT recently. If you haven't seen it, I would urge you to Google it and read it, where he basically said companies explaining is boards being sovereign and proving that they have the governance over their institution, and we welcome that. We do need in the UK to move away from what I describe as teeth sucking, that you don't want to do that. We have a comply or explain regime, we've had it forever, and somehow we turned it into something that required a textbook exercise. The FRC didn't do that, we did that to ourselves, and that's a cultural piece that we need to unlock. The stewardship code has been reversed by one stage, as it were, in terms of definition of stewardship. We triggered the conversation about remuneration, because if you want to be in a war for talent, to create globally consequential companies, we have to recognize we want to attract the best talent from around the world and pay them to do so. And as a consequence of that, the IA has changed their guidance. CMET stuck its head above the parapet a bit on this topic, and we have seen a radical shift there. And the fifth finger was the ecosystem for scaling consequential private companies. You cannot have, by definition, consequential public companies unless you first have consequential private companies. They were represented on the previous panel. And in that, actually, one of the things that was asked for as the last panelist is something we've already done, which is in creating PISES, the Private Intermittent Securities and Capital Exchange System regulation, where the R is silent. We have created the world's first regulation to create secondary liquidity for private companies with beneficial tax structures associated with doing so. We've had the first transaction already take place. The second ones are being structured at the moment, but is deliberately designed to create liquidity events for private companies, either to allow angel and seed to get out, to allow our pension funds to start buying them, to give management and leadership and employees liquidity, and it is already working, and it has been announced that the EU is basically going to lift and shift it into their own regulation. I'm saying that kind of copying is the best form of flattery, or whatever the right phrase is. So that has already been addressed, and we have the Mansion House Compact and Accord. The final piece of the glove is the culture. It's how we talk about it around here, and that was also reflected on the previous panel. Actually celebrating entrepreneurship, celebrating people who make businesses. I have the privilege as CEO of the Exchange of standing on the balcony with founders very, very regularly. Most of them have put their money, their mortgage, and very often their marriage on the line to make these companies and to create value. And they've done it very often to solve a problem that they felt needed fixing. We should back that as a nation. We should recognize it and we should celebrate it. And we should actually make people realize that we haven't stopped a company from being a company that's bricks and mortar and does real things when we turn it into a financial instrument. We've just given more people the opportunity to share in the value that those companies create. And we need to shift the narrative. So a lot of the work that we're doing is to continue to try and shift that narrative. CMET got further in the 5 fingers in a glove than we ever anticipated in the first 3 or 4 years. So we have now pivoted to what we describe as the 2 Cs, capital and culture. The two are interlinked, and it is very much about getting those domestic flows of capital either restructured as proper risk capital or very much focused on investing in the UK and recognizing the value we create. For every equity investment we make in the UK, you don't just make the return for the pensioner, you put the money into the company, you also then get the incremental tax revenue and the economy benefits as a whole. If we want to increase the savings rate in the country, we have to invest in the country. We have to increase the productivity to increase the savings rate. We have to create that virtuous cycle, and that is the next piece of the puzzle. But an awful lot of the groundwork has been laid. And on the culture piece, the Savvy Squirrel campaign will continue, but we're also going to put our head much more above the parapet and celebrate entrepreneurship and great British companies as the Exchange. Because if no one else is going to, we're going to have to do it. So, there you go.
I think the abiding message from that you can see, and you probably heard it from the previous panel as well, is that there's so much that we've done. You know, in the day job, I sometimes, being a corporate lawyer for my sins, you compare listing venues, and we did a study at the end of last year looking at all the stuff that had happened in the UK, literally line by line, listing regime, remuneration regime, corporate governance regime, indexation, takeover, follow-on regime. And what comes out the bottom now, because of all the work of the last 6 years, is that London is the least frictional listing venue in Europe. Now, others know it. They're starting to comment. The EU Listing Act is largely based on what we've done in this country. You're seeing other jurisdictions like Stockholm follow suit as well. They had an IPO last year. They've got had a few IPOs, but they recognise that the UK is less frictional than they are now, and they're all racing to catch up. Sometimes you hear this narrative that, well, not much has changed. It has, because I remember when, with Jonathan Hill, we used to bowl around the city in September 2020. People say, really? We're Brits. We don't need to reform. It's all okay, isn't it? I mean, if you think about that from that perspective, the conversation has moved on so far. But we can't be complacent, and we have to still press on with the things that we know we still need to press on, which are, to some extent, the harder things. I mean, the culture bit is hearts and minds. That's changing a British way often of thinking about things, of addressing things, a market practice type point. And the capital point, obviously, it's not just down to people like us to change those rules. You need governmental and consistent governmental policy that help make those changes. Sian, we should come to you. I mean, that's sort of talking about the UK and CMET and the journey we've been on in the UK. What from the sort of investor point of view would you say how people are viewing the UK markets at the moment, investor attitudes?
Yeah, so I mean, firstly, I would say that the reforms have been fantastic and a really positive development. But as one particularly savvy investor said to me, it's great we've polished up the car, but now we need to be able to put the petrol in it. So we really need to make sure that we are getting capital into the UK market. And I think you need to look at that through both the lens of an institutional investor, but also through retail investors. And if I compare it to what is probably the most efficient and liquid market in the world, the US market, we are woefully underinvested as a nation in both public and listed equity. And a good illustration of that would be our defined benefit pension schemes have approximately 3% of their assets in UK listed equities. Defined contribution is not much better, although defined contribution has increased the amount of allocation to equities. It's largely been to international equities at the expense of the UK. So the investment in UK equities has actually been falling since 2019. So what we really need to do is to figure out how do we get more of that international focus on the UK, but also get the domestic focus really back to investing in UK assets. I do think there is also a risk with how dependent some of our UK companies are on overseas capital. And that's particularly true at the moment where there is increasing geopolitical risk, which can mean that some of that capital might be repatriated, whether or not that's to North America or to the Middle East. That does leave us a little vulnerable, and domestic capital does tend to be stickier, does tend to stick with the with domestic companies more. The US, for example, has approximately 60% of its investors are invested in domestic equities. Now, if I turn to retail, we are a nation really of savers, not of investors, and that's been true over at least 2 decades. If I think about how do we store wealth as a retail investor, we tend to store it in property, our principal primary residence, and in savings. So around about 65% of retail wealth is in those 2 asset classes. A mere 10% is invested in either mutual funds that are invested in equities or directly in equities themselves. If you look at the US, that's around 30% is invested in mutual funds or in equities. So it's really critical that we try and change the mindset and the culture of investing at a retail level, really away from this fear of losing money to what is it, the fear of actually, if you aren't invested, what that can do to your wealth prospects and to your retirement income. And really think about how do we get people more focused on, you can invest in growth stocks, you don't just need to invest for yield and for dividend payments. So I think there's a lot of work that needs to be done around education within the retail sector.
And which you are starting, as Julia mentioned, in the retail investment campaign and Savvy the Squirrel. I mean, I personally on this tend to think a lot of it starts at home. You know, how do you get the next generation for those of you who have children? And it's talking about it at home. It's showing them the apps you can use now. Talking about what's the difference between a Tesla share and an Aston Martin share. Why would you buy one versus the other? Obviously, I think everyone should buy an Aston Martin share, notwithstanding that there's stamp duty on it, which is one of Julia's points that she often makes. But that I think a lot of that starts at home. People sometimes talk about, oh, we just have to create a 401k culture like in the States. It's not as simple as that. You can't just lift and drop. It has to be culturally attuned. Anne, coming to you, how do you sort of see from a investment point of view, you know, the relative competitiveness of the UK market compared to in the context of the arms race between listing venues that we see at the moment across the globe?
Yeah, from an asset management point of view, I think it's important to put the UK in context from that perspective, and that is that the UK is the second largest domicile in the world for asset management. And just last year, we breached the 10 trillion pounds in assets under management, which is a significant achievement. What's more interesting is that now we invest over half of that on behalf of international investors. So we also must remember that the UK is very much a global hub for international investors elsewhere. So there is this balance in what the conversation we're having today between supporting UK capital markets, which is really important, but also maintaining that international perspective that we've built up over time and is really crucial to what we do and the integrity of the system. From our point of view, it is demand, and it's how we drive demand. And we've touched on it. It really is unlocking sources of monies that can invest in the UK capital markets. But also we have to acknowledge that some of those monies will go into international markets if we do this right, because diversification fiduciary duty is at the heart of all that we do. And so the retail investor is absolutely where we can unlock this value. 600 million, on a billion rather, on deposit for UK retail investors is what the pool of money is that we should be accessing. And again, as Julian and Shane have said, you know, why haven't we done it before? It's because of risk aversion, it's the cultural bias towards investing in property and cash, it's financial literacy, but it's also around product complexity, and it is around access as well. And we haven't facilitated access, easy access, because it's not just about obstacles like risk warnings, which deter people from investing, but it's also thinking about technology. And we have a really wonderful opportunity now, because there's two things. We have a generation of people who are used to engaging with technology. And so to your point, Mark, how do we engage that generation? We do it through technology. They will not go and sit in front of an advisor of any kind. They will want to buy it at whatever point of the day or night that they decide to do so, on their phone and pretty instantly. But that's an opportunity if we get that right, and that's around advisory models, it's around access, it's around pricing. And also the other opportunity that awaits all of us in this industry is that there's a transfer of wealth that's coming in the next 10 to 15 years. Significant, that's global, it's also here in the UK. And that transfer of wealth is going to this generation who engage with everything on technology. So if we get it right for that generation, you know, this opens up a whole long-term access that we will all benefit from.
No, I totally agree. We were having dinner last week, I think it was, with some very senior ECM bankers, and it's a nice segue into John in a second, who were iterating how important the retail investor is in global markets these days. I think I might be wrong, but I think 60% of the US market is now retail. I think it's some number like that, isn't it? I mean, it's an incredible number. And you're seeing the same in Hong Kong and Asia generally. And the point that was made at this dinner was those markets who aren't harnessing the power of retail are missing out and are going to continue to miss out. And that's why it's so important. It was actually interesting hearing, and Bob's an ex-banker himself, but hearing bankers actually talking positively about and pushing the retail agenda, because I remember even 4 or 5 years ago, you talk to a retail banker, Wilco, John, and talk about getting retail into a book. And they, oh, well, no, we'd rather not, thanks very much. But that's a totally different story now. And in the UK, you know, most secondary offerings, you have a retail element. Well, John, with that, I might throw it over to you. So from the sort of advisor, international advisor perspective, to sort of give your sense on pipeline, how you're seeing the market at the moment in the conversation you're having, both with putative issuers, actual issuers, and investors.
Yeah, and I think, you know, for those of us kind of at the coalface of the pipeline that's coming, I would say we feel actually very encouraged. And one of the points that was made on the previous panel was that we need to see activity pick up again, and we definitely see and feel it coming. Mark and I were comparing notes before. You know, we could see, you know, between our two firms a pipeline of at least 10 IPOs in the UK over the next 18 months of, you know, really materially sized businesses. We for context, have 7. I'd say 6 of those could easily have chosen another market. The UK wasn't necessarily must do. And, you know, we moved from, I'd say 2-3 years ago, that wasn't explicit, but the body language was like, how do we list elsewhere? To, you know, genuine debate, and almost, or certainly many of the outcomes are actually the UK is the right place to list. And so the debate has gone, you know, swung completely the opposite way. So I thought it might be helpful to just touch on some of the kind of dynamics we're seeing about that, around those topics, to provide a bit of context. But we definitely feel and see, you know, the pipeline is building, there is going to be tangible progress, and there's some really good companies that could come to market in the UK, and that will completely change, you know, this narrative, because as we've said, the investment in the reforms has been made, we just now need the supply. And I would say part of that is we've seen some activity. As you know, two swallows don't make a summer, but there were a couple of IPOs of scale in the fourth quarter last year in the form of Shawbrook and Princess Group. I would say, having led one of those, you know, we saw no difference in investor behavior, quality of book, et cetera, to those IPOs we were leading in Germany or Sweden or Switzerland. You know, the same patterns were being observed. There was no why UK pushback from the buy side. It was a very, you know, very successful, you know, listing venue for that in that regard. And we saw very strong international demand, as we've been talking about, you know, in terms of international capital flowing to the UK across a number of these conversations. Two, I think there's just, you know, there's a high degree of familiarity and comfort with the UK market. For those companies that aren't necessarily based here, have big global businesses, there is, of course, the UK is a sensible place to list. That doesn't always feature in the conversation when you're talking about Amsterdam or Stockholm or Switzerland. And even in the US, if there's no strong US nexus, companies, you know, have a degree of nervousness about going there that they don't have with the UK. If we focus more on the kind of reform side, I've got a couple of tangible examples where, you know, where it's made a difference. So one client we were advising a couple of years, 2-3 years ago, who was looking at the UK to list, but they were a big roll-up story. They'd done a lot of M&A. The complex financial history was a problem in terms of eligibility. Those rules have changed. That's not a discussion anymore. It's a very simple conversation we're having them. Secondly, float and index rules. You know, there are a number of companies we're advising who are large and only want to list 10% of the company. They may not be incorporated in the UK, but they'll get the same treatment as a UK business now under the new rules in terms of their ability to list just 10% of the company, their ability to be index eligible. And that has been a material, tangible, important development. Third thing I'd say is currency of listing. We've got 2 issuers in our pipeline who are going to use either euros or dollars as share price denomination. Different reasons why it's important to them. Some is because they have a very active M&A. They want to have a currency that's listed in a currency that's relevant to the targets they might want to pursue. Others are, you know, have a big part of their business in foreign currency, and they want to reduce the volatility in their reporting and how it relates to share price. So those are small things, but they do matter in swinging the balance sometimes. And then I think, you know, I wouldn't say the shine has come off, but there's a lot more education and understanding around, you know, the US market now that necessarily may not have been there as people have dug into what is required to list there, and you talk to a CFO or a board about what the lead time items are around financial reporting, Sarbanes-Oxley, et cetera, you sort of get a raised eyebrow and, you know, okay, that's actually not a free option. We've got to really think about this. And in some cases, materially extends the lead time to market for them. So you know, those are important practical issues that we've been uncovering, and in the context of the removing the headwind side of the equation, have tipped the balance materially. And the last thing I'd say is, you know, the US is not a panacea for all. We've talked about some of these factors, but, you know, we talked about scale on the last panel. I think absolutely agree with that. The entry size in the UK market is not the same as it is in the US in terms of being relevant and important. And that's important given how many companies in the pipeline are mid-cap in nature. Secondly, I would say, you know, there is sometimes we talk to companies where there's 5 or 6 comparables listed in the US, there are none listed in Europe or the UK. It's an opportunity, not a threat. Scarcity value is important. And then lastly, you know, we talked about a little bit about how the US has got it right from a retail perspective. There's also a huge element of that market is index linked. If you don't tick those 2 boxes, you know, it could be quite an uphill battle for you. And so relevance and right to win in the US market is not guaranteed for all. So I'd say, look, in summary, you know, we feel very encouraged by the pipeline. We certainly have the supply side there through the conversations we're having with those companies beginning their path to the market. The interest is definitely there. On the demand side, it's now keeping our fingers crossed that the markets and macro environment sustains itself as we see those companies coming through.
Yeah, I mean, I think one of the things we talk about, and I agree with all of that, John, from a slightly different advisor perspective, but I think one of the things we sometimes talk about in terms of how we should frame the UK on the back of all the work we've done in the last 6 or so years is we are now an international, what we've always been, an international financial centre that has the benefit of taking all the frictions out of the system, or the majority of them, has time zone, has solid and stable regulation, language, And importantly, it's not the US, it's not Asia, and it's not the EU. That is the narrative for London, coupled with a sense of optimism and a sense of innovation that we've always had as a country. It's not the narrative you'd always believe would be the case if you believe the public narrative. And that's not blaming anyone in particular, it's just that we as Brits are quite good at being Eeyore, to come back to where we started. And actually, we need to start backing ourselves a bit more and being a bit more shouty about what we've done. I sometimes talk about channeling our inner American. It's not just because I work for an American law firm, but just being a bit more insurgent in our thinking rather than incumbent and pushing the narrative. I mean, Julia, you sort of travel talking internationally about that. Do you sense that's changing?
Oh, it's changing enormously, and I think it's changed for a range of reasons. I think, firstly, just objectively, the rule set that we have now and the proposition that we have as a market has changed. And I tell the story a lot, but I was sort of, when I arrived at the exchange and I looked at my primary markets origination team, the phrase that came to mind was that one that Ronald Reagan said, that the most dangerous words in the English language are "I'm from the government and I'm here to help." So if you're a primary market person of a primary exchange, then if you were meeting with a company, they know what you're going to talk about. Our client base is quite small, if you think about it. It's companies that want to go public, companies that want to be public about the fact they want to go public, and companies that want to consider going public in the UK. And every primary exchange in the world meets that requirement. But London's actually unusual. We're the largest equity market in Europe. We're the second largest debt market in the world. We're the largest closed-ended fund market in the world. In fact, we've just launched this morning the Uzbek National Investment Fund, the first ever IPO from Uzbekistan anywhere in the world, done in London, 4 times oversubscribed and trading up really quite considerably since it IPO'd last week. And so we have all of those. We now also have Pisces. So we can sit in front of a company and just say, how can we help? It's a very different conversation, and that is really cutting through. But when you talk about the things that have also been referenced, the index eligibility changes, the ability to operate in different currencies, the thing that we can say, and I do say internationally, is, look, the entire rule set that we've changed in the UK has been founded through the ambition for the UK for great companies to start, grow, scale, and stay here. But we also presume that every other country on the planet wants the same thing. And we don't, our capital markets do not require companies to turn themselves into a pretzel to meet our requirements. Whereas, to be honest, if you want to get the index eligibility, which is essential in the US because it's got a far higher percentage of indexation than any other market, you've got to either be domiciled in the US or have substantively all your revenues in the US, and you've got to hit a size threshold that most companies do not. And we have decided to take being the most global venue in the world with the principles of what we want to do for the UK and make sure that it fits that you can be the best of both. It's also increasingly aware around the world that the US is not necessarily the panacea. Now, we've been tracking the data, and my team just sent me the update just before I came on stage. There have only been 20 UK companies that have actually gone to the US and raised over 100 million in an IPO since 2014. 3 of them are trading up, 12 have delisted, and the remaining 5 are trading down by 86% on average. Now, the interesting thing is if you look at that for kind of mid-cap tech companies, or if you look at that for companies from Asia, or if you look at that from companies from a range of different places, you get exactly the same stats. And so I think the awareness that the US is not the panacea has shifted, but we have also made our proposition very different. And I think Pisces is also changing that as well, because you can have an early stage conversation with a company about genuinely providing them with liquidity solutions that you couldn't before. So we are very definitely seeing that kind of, we're open for business as an international venue, but our domestic proposition is also much more competitive.
And thematically, I think what all of these conversations, whether it's actually in the UK or anywhere around the world when it comes to public capital markets, all stems from one thing, which is that over the last 30 or 40 years, regulators, governments, various stakeholders, we've allowed the public markets to become too divorced from the private markets. And the delta between public and private markets has become too big. So really, this whole exercise is thematically about narrowing that gap. Because private markets are here to stay, we know that. They're all, they are deep, they are going to become deeper. And often, like Julia was talking about with Pisces, the interesting bit is actually in the junction between the two. But we still have work to do, both in the UK and globally, in terms of public capital markets, in terms of narrowing that gap, whether it's director liability, whether it's remuneration, whether it's general obligations and reporting obligations on public companies. Because for too long, there's been this perception that just because you're public, you can have as much regulation thrown at you as regulators and government like, which is larger companies can bear that. Small and mid-caps, who are the lifeblood of our capital markets in many ways, can't in many cases.
Can I just make a very quick point as well? The one thing we also forget, and Mark talks about being less Eeyore and more Tigger. The phrase I use is that we need to stop throwing shade at ourselves as a nation and then wondering why it's a bit chilly and a bit damp. You know? I think that we sometimes forget the strengths we have. And in AIM, we have the largest growth market in Europe. In the last 30 years since AIM was created, there's an awful lot of European growth markets that have started and failed. 53% of all the capital raised on growth markets in Europe in the last 10 years has been raised on AIM. We had the largest ever capital raise last year of £1.15 billion, and it was completely eclipsed earlier this year with a £1.9 billion raise. But they matter because those are companies that are predominantly based here. They add genuinely greater GVA to the national economy, to the tax base, and employ lots and lots and lots of people. So yes, I care massively about the large companies we have at the top end of the FTSE 100 and making sure we're attractive for them. I care that we work across the funding continuum and we have a market that works for companies at every stage and every size, because that's how we create consequential companies that drive the economy, and make sure that we make it as attractive as possible for the companies that want to meet our rules to also access our market. Partly, hopefully, that gives them more lockers and more willingness to invest in the UK. But it also means that actually UK investors are very good at understanding global stories. And increasingly, as we create globally consequential companies, more and more of their revenues don't actually get made in the UK, even if they're based in the UK, they get made overseas. So it is actually a beneficial thing. We need to stop treating these things as either or and recognise that two things can be true at the same time. And I think we have more strengths than we realise in our capital markets.
I'm conscious we've got about 5 minutes left. I just wanted to check if anyone has any questions for any of our panellists in the room.
I can't see any questions, sir.
No? Okay, I mean, we've got about 5 minutes left. I mean, one thing I might just come to you first, Anne, and then to Sian and John is two things. One, the rise of passive investors and what the real implications of that are. I think it's often misunderstood, and I might come to you, Anne, first. And the percentage, obviously passive is rising and rising and rising versus active, and not just in the UK but in all jurisdictions. And what impact do you think that is likely to have on our markets and their continued thriving nature? And then secondly, and this to each of you, stamp duty in the UK, that topic. Now, the previous panel touched on it a bit, but I'm interested in how important you actually really think it is as a potential and its removal. Anne, to you first.
Yeah, so on the conversation of moving from passive to active, I've been in this industry for 30 years, and it's been phenomenal for those 30 years. And for those 30 years, we've tried to establish what the impact is. And I think it's just part of the ecosystem now. So investors will be discerning where they want access to a particular market, particular asset class, and they can do that through an index strategy efficiently. They will do that. If they want to drive alpha, they now have fewer options, but maybe better options. And I think just to broaden it from the public listed market to private markets, I think that's the more interesting part of this. And in fact, what investors are trying to do is, again, think about how they access private markets systematically like you would through an index portfolio, which is difficult because the characteristics of unlisted stocks and unlisted asset classes are very, very different. But I think what's more interesting is the increased appetite for private markets. And coming back to the conversation we had earlier about retail investors, I think that that's important that we make access for retail investors more prevalent in the unlisted part as well. And the government are trying to do that through including LTAFs and ISAs, and I think that that's a good first step because it's not a no-brainer because retail investors, those who are more sophisticated, do want access because they offer, like I say, more and different characteristics to listed markets around the long-term returns, the risk-return trade-off, but they need to be educated about the illiquidity aspects of it. So if we do it through a product structure which explains all of that, I think that that's what we can do is get the protection and the trade-off more accurate. In terms of stamp duty, my other panelists will have stronger views, but in the broader, when you're managing an international portfolio, it is definitely not helpful, but it's not the biggest issue.
Used to it.
Yes, yeah.
John, what's your perspective when you're talking to future issuers and they bring up stamp duty?
There's just a huge desire to see it gone. You know, it's a needless frictional cost that exists in the market.
And passive, do you see that as a...
It's an interesting one because I think it's obviously important. Everyone would see the direction of travel of the share of the market that's now made up by passive. It's only going in one direction, and when you add to that ETFs, etc., it just grows and compounds, right? I think it's on the other hand very interesting to see how that's growing. But equally, when you think about that capital, it's very stable. It's obviously a benefit. It's a nice home to put the shares of your company in. But actually it bears little resemblance to what drives share price day to day, which is completely changed in the opposite direction. Shorter term, retail, quant, electronic, there's so many other factors that determine that. And so there's two very opposing forces in terms of growing ownership of what makes up your cap table versus what's actually driving day-to-day stock volatility.
What's your perspective, Sean?
Look, I think in order to ensure that our capital markets grow, you need to get rid of as much friction as possible and create incentives. So my view would be to get rid of stamp duty because it is a friction. You know, several markets do still have a financial transaction tax. Many don't. And I think that on balance, it would be preferable to eliminate it because it's just one more friction that we don't need. And if I think about passive, again, the view is we want to get more people out of cash and into investing. And I think that probably the easiest way, the most liquid way to make those early steps is to invest in something passive or tracking, which will give people starting to get some education around markets. So it's huge. It's a huge market. It grows every year, and I do think it forms a part of a good balanced portfolio. But I do think it's more than just about the passive. You need to think about that whole capital market and how you allow investors to access all of it.
Fantastic. Well, look, we've hit time. So thank you to John, to Anne, to Sean, to Julia for joining me on the panel. I hope you can feel that and see empirically that there is optimism. There's more work still being done as well. One of the things I'm doing at the moment is a DMAT task force, which is charged with getting rid of paper share certificates by the end of next year, and then moving everybody onto a proper digitised shareholding system starting in 2029. Part of that will be going back to what Bob was talking about, which will also be making sure that we are, as I call it, match fit for a tokenised world, because that is coming. There's no doubt about it. We have a head start there at the moment. We have more to do, but that's the next generation of our capital markets. Anyway, thank you to our panellists, and thank you for taking the time.
Well, thanks, Mark, and thanks to the rest of the panel. I think a really very interesting conversation about what is going on, what's been achieved, and what's more to come. We're now moving on to the potential of the EU Savings and Investment Union to underpin Europe's capital markets. I should say I was with Marie-Louise Albuquerque a few weeks ago, who is I've forgotten exactly what her title is, but essentially the person who runs the office in the EU that deals with financial services, and she was complimenting the UK on its ISA regime. She'd been studying it carefully, and the EU, of course, have designed an investment product for EU savers and investors. And we had a very interesting conversation. She was asking me about why had the PEP, which was, of course, the original product, been so successful. And I said, actually, you have to credit Mrs. Thatcher, a name that one doesn't mention in Europe too much, with the most brilliant set of measures, which, if you remember back, included three things. It was the creation of the PEP, which obviously became the ISA, which gave tax incentives to invest in UK equities. It was a supply of companies, which came from privatisation, and it was the SID campaign. And I'll be very interested to hear when this panel get going whether the EU has similar ideas around its capital markets union and whether it's going to create that same set of events. Obviously, they're not going to be privatizations, but maybe there are other ways that they could provide a supply of companies. So with that, let me introduce the chair of the next panel, Cecile Nagel, Global Head of Corporate Trust and Head of London Branch at BNY, 20 years in the industry, previously serving as EMEA Head of BNY Mellon's Pershing business. I would say Cecile is best known for being at the forefront of embedding new technology into custody services, but is very much an expert in market infrastructure, trading and post-trading. So a great person to chair this panel. Cecile, over to you.
Good afternoon, and we've heard a lot about the UK, so we turn to Europe now, and probably there are probably a few issues that are more important to Europe's economic future than how we turn Europe's savings into productive investment. The Savings and Investment Union has the potential to be the defining catalyst in deepening Europe's capital markets, improving cross-border investment flows, strengthening liquidity, and ultimately driving long-term economic growth and competitiveness on the continent. We heard it about the UK. Similarly, in Europe, there's no shortage of savings. The challenge is that too much of that capital still sits on the sidelines rather than being channeled into businesses, the growth and innovation that Europe so desperately needs for the future. So at its core, the SIU is about closing that gap, better connecting savings with investment opportunities. And we see this every day at BNY, helping our clients, asset owners, asset managers, financial institutions across Europe, trying to provide them with the services to deploy capital at scale, safely and efficiently. So over the next 40 minutes or so, we're going to dig deeper into the topic of the SIU with a very distinguished panel of financial services leaders. So maybe I'll just ask my fellow panelists here to briefly introduce themselves.
So, good afternoon, everyone. My name is Thierry Dargent, and I'm the CEO for SocGen in the UK.
Good afternoon, I'm John Berrigan. I'm the Director General of DG FISMA, which is the Commission Service for Financial Services in Brussels.
Hello, my name is Sophie Melenders. I work for Euroclear, and I'm the Head of Product Strategy and Innovation for Europe, UK, and our data products.
Hello, everyone. My name is Vathani Vijayartna. I'm the CEO for Deutsche Bank here in the UK and Ireland.
Okay, thank you. So, John, maybe I'll kick it off with you. Maybe you can help us set the scene. And, you know, the question I'd ask is, why is now the right moment for the European Union to push for the savings and investment unions? And what opportunities does it bring to citizens and businesses?
Well, thanks. Actually, the right moment was probably 20 years ago, if I'm honest. And I was there 20 years ago, so I know.
I'm old enough to remember the Giovannini barriers.
Well, I wrote that, so I'm even older than you. So now, it is, of course, this is the latest of repeated efforts to do this. We've had, in fact, it's been going on since the mid-1980s, if we're honest. And then we've had various attempts following the launch of the euro, then the 2 CMU action plans, etc. So the time, I think, was right some time ago, but it's particularly right now. And why is because the context has changed. I think, to put it kind of bluntly, what was always thought of as a nice to have for the EU, that is a capital market, because we had such a good banking system, has now become a need to have, because the banking system isn't really able to finance the sort of investment we need in a 21st century development. That sort of higher risk, higher innovation type of investment, where equity is required and not just debt. So banks are not that well suited. So just having a nice developed banking system, it could be more developed, could be more integrated, but it's pretty performing, isn't enough. So you need now to turn to capital markets. I think the backdrop, the context that changed is essentially started with the Draghi report, which was, there was nothing particularly new in the Draghi report. It was just that he brought it all together and basically explained what is the problem in the EU, which is sort of low growth, driven by low productivity, falling behind in innovation, and all that wrapped up in some nasty demographics. And the solution is a general equilibrium solution. Of course, you have to have reform in many places, energy, transport, labour markets, but also key in the financial system, because none of these reforms will work unless the financial system is optimized. The other context change is geopolitics. I think we have seen that the old order, rules-based order, is transforming into something else, which is much more regional, much more competitive. And I would say the geoeconomic, if you can use that awful word, but the geoeconomic overlay of what was the old globalized system doesn't work anymore. So the geopolitics and the geoeconomics don't work. So there's a lot of change going on in the world economy. And it's, to put it bluntly, it's not a place to be small anymore. So if you want to be relevant in this new world order, you're going to have to be of sufficient size and sufficiently efficient. So again, even though Draghi preceded what happened more recently in the geopolitical world, it's the same message. We need to become more efficient, and the general solution to that, as posited by Draghi, but as is obvious, is, at least in the EU, to complete the single market. We have it, but we haven't completed it. So the general solution is the single market, and that's the solution in the financial services as well. As you said, we have abundant savings. They sit in bank deposits, and they sit in bank deposits because there's really nowhere else to put them in the EU. There isn't really a capital market in which you can put that. So it's kind of chicken and egg. If you want a really buoyant capital market, you need retail participation. But if you want the retail investor to go in, you have to provide the offer. So this kind of mutual interaction is where the title came from, Savings and Investment Union. So the idea is to bring retail savings in particular into a system which intermediates them efficiently through efficient infrastructures in an integrated market to the most productive investments. So that essentially is the strategy. It's worth mentioning that the SIU is not just about capital markets. There's also some work to be done on the banking system, but we can come back to that another day. But the key part of it is what we're going to do on the capital market. What does the retail have to get from this? Well, as I said, one of the reasons why SIU is working from a political point of view today is because it's no longer seen as an end in itself. The Capital Markets Union was often seen as just people like me trying to create a capital market because I thought we should have a capital market. But actually the SIU is much clearer in terms of what it's doing. It's part of a solution to a bigger problem. It's part of a solution to growth. It's part of a solution to pension sustainability, etc. And it's in that context that it makes sense to bring retail into the market, because if you live in a world where you don't need to make additional yield, then you can leave your deposits in a bank at 1% and let inflation take out 1 to 2% a year over time. But if you live in the real world, which is a world where, in fact, if you're a retail investor and you're looking forward, your pensions may not be sufficient from the state, then this whole question changes. The whole dynamic changes. Now you are looking for return. You will have to take a different risk-reward choice, but you need the market to be there for you. So what we want to do is create the market which allows the retail investor to participate, boost reward for the retail investor, and at the same time use that then to channel investment into productive activities. So it's a kind of win-win proposition. As I said, political support is higher than in the past, but the decisions remain as difficult as they have been in the past. But what I will say is that the costs of not making those decisions are now much higher than they were before. So I'm reasonably optimistic that we will make some progress this time.
Okay, thank you. There's a lot in there. Let's maybe go a little bit deeper on some of the topics, and maybe we start on capital markets. And one thing that always strikes me is the balance of financing between Europe and the US, right? In the US, 2/3 of activities financed via capital markets, 1/3 via banks, roughly. In Europe, it's the other way around. So Thierry, maybe I'll ask you the question about how could deeper capital markets reshape that balance, and what is needed to achieve this?
Thank you. I think I mean, going back to your analogy on the US, I mean, we all see every day the amounts of investments that are announced on a daily basis in the US on the technology side, on the technology infrastructure side, et cetera, and you got to wonder where is that coming from. To John's point, I think there is first and foremost a question of incentives, right? If you do not have a pay-as-you-go pension system, you're forced to invest. I mean, the outcome at the end is going to be based on the investments you've made. Now, how that is organized, how it is channeled, is obviously, I guess, some of the topic here. It is fundamental because, again, banks do finance 70% of the European economy. But banks can only do what banks are allowed to do. Banks will not invest at scale in equity, for example. Even on the credit side, there are limitations to what you can do for prudential reasons, which are probably there for a good reason. And you can also always argue about, changing some prudential rules here and there, but fundamentally, relying on bank financing is always going to be a limitation to the range of what can be delivered in terms of investments. Now, if you think about, what happened in the U.S., two things happened. First, pension funds and the structure of pension money, I should say, or pension money investment evolved materially over the last decades. And the second thing is that the securitization market, we might speak about that later on, but really exploded. And that is the market by which banks can actually do more of what they do by offloading some to capital markets. So again, deeper capital markets are an essential lever, if you want, for all that money to be channeled. Now, if we think about capital markets at the European level and under your supervision, I should say, under your control, there's clearly strong political momentum behind the SIU. There's been some renewed momentum. And some of the underlying factors now need to be put in place. So if you think about what it takes making sure that there are some, if you want to make sure that these capital markets are at scale, they cannot be fragmented. And right now they are, to a large extent, because things as simple as solvency rules will be different between the member states. The market, the regulation around savings products are different. Taxation schemes are different. So it is not, if you invest in a French equivalent of an ISA, well, that's not available to a German citizen because they will have no benefit of that investment. So you need to harmonize all these things. Now, once you get there, you all of a sudden create a scale in terms of investment source, which is very different from what can be obtained at any member state level. And if you think about the scale you can achieve, obviously the UK is special because we have a lot of, we have a pension system which is quite different from that of a number of European countries. But you have, I'm not going to say a definite figure, but a number of trillions of pounds that are invested, adequately or not is a different question, but you have a lot of money linked to pensions and the need for people to invest, right? That is one thing. You have savings on top of that, which you can, even if you have a pay-as-you-go system, you can still mobilize to invest more. If you think about the equity gap in Europe, that will not be solved by banks. So that can only be solved if, indeed, we build European scale investment products where you can generate equity investments at scale. Because the other thing, of course, in equities is if you don't have scale, usually the risks are not commensurate for a small investment platform. So to your point, it would change things dramatically in terms of being able to address the needs, and there are many, they're pressing, to your point about the context in which we operate. And there is an element of urgency in this whole thing. So I think that we need to make progress on harmonizing investment parameters, so for savers, and we need to make progress on securitization as well to leverage on banks' balance sheets better.
Okay. So maybe I'll turn to you, Vathani. We heard a lot about the UK, heard about some of the similarities, some of the differences. What would a successful SIU mean for EU and UK competitiveness and the EU-UK relationship?
Thank you, Cecile, and it's a great pleasure to be here on this panel with my fellow panelists, Thierry, John, and Sophie. When I think about the question of what it means for the EU and the UK, I'd probably start with the assumption that I don't think we should be looking at this as a zero-sum game for the EU or for the UK. So John touched upon the point of what drives the SIU in the European Union. And we have a similar challenge, albeit with a slightly different strategy here in the UK. So in the UK, we have the Financial Services Growth and Competitiveness Strategy. We have financial services seen as a key enabler of the industrial strategy. And John referenced earlier on in this conversation how the SIU is really seen as a differentiator because of its connectivity and its power to enable the EU in its economic growth. So a shared challenge. And my hope is therefore that the SIU, if done right, can be something on which the rising tide raises at least two boats, not just one. So why do I think that, and what does it take for that to be the case for a successful SIU? When you start with the point that both Thierry and John mentioned in terms of a goal of the SIU was deeper, more liquid capital markets, and in doing so, reducing the friction between member states and enabling capital and risk to flow more easily from point A to point B. That will inevitably lead to greater benefits for those within the EU. But let's not forget quite how interconnected our markets are between the EU and the UK. And many of the panelists up here are UK heads or London branch heads of EU institutions. So it's a question that I'm sure all of us spend a lot of time thinking about. But just to give you a few data points to illustrate that fact, around 2/3 of euro-denominated derivatives are cleared through London. Around 1/5 of EU domiciled funds are managed from here in London. So highly connected systems that operate interconnectedly. And so for me, a successful SIU should be looking to build on that, to build on what we already have and enhance it further, rather than cut across it. And that to me is a key point of what I would hope that we achieve with a successful SIU. The second part that we started to discuss and have touched upon is mobilizing capital. And again, the challenge there is mobilizing the capital within the EU. But this again is an area where we're highly connected through cross-border activity between the UK and the EU. So as an example, about 25% of EU VC deals had UK investors in it for the 3 years running up to 2024. And about 28% of UK deals had EU investors in them, so highly connected already. And when you unlock the capital that is available within the EU, whether it be individual savings or pensions, one assumes that will absolutely benefit the companies and growth within the EU. But that capital, as with any other capital across the world that we've seen, will be available. We're looking for the most attractive investments for itself, and therefore within the EU, but also other locations such as the UK. And so for me, I think those 2 points together with the third, which is the one on the question of what it does to the EU-UK relationship, is really the key part, that we absolutely should be looking at this as something that isn't a zero-sum game, We have the same challenge here in the UK as the EU has in many ways. We should be looking to address it through greater dialogue and cooperation, and with that, building on the interconnectedness that we have. And we've seen the signals across that. There's been a lot of news flow, but one of the things that happened last week is obviously the King's speech, and there was a clear signal in that around the European Partnership Bill. We have the UK and the EU summit coming up as well. So that ability to work together and increase the dialogue to achieve these goals is there. So in summary, I'd say for me, for a successful SRU for both the UK and the EU, we should be looking to grow the pie together rather than cut it a different way, and do so by building on the already interconnected and operating well systems that we have, and through deeper and greater dialogue.
Thank you, and I guess that also builds on what John was saying initially, right? The momentum, the urgency, the geopolitical environment has changed, so really an opportunity for both the UK and Europe. But let's really turn on to a slightly different theme, because at its core, the SRU is about economic growth and competitiveness, and we can't talk about economic growth and competitiveness without talking about innovation. And so I'll ask you, Sophie, the question, what role can innovation, and particularly digital innovation, play in making the SRU more efficient and in freeing up capital for investment?
Yes, thank you, Cécile. So I'm going to give you the perspective of a financial market infrastructure. At Euroclear, one of our main goals, as you know, is really to constantly simplify the post-trade world for investors and issuers through robust and automated processes, so that our client base can actually focus on their core business. Now, our proposed model within SRU is to do exactly that. We want to create a simple cross-access for all of our clients, i.e. single access point, single operating model for all types of securities, equities, ETFs, bonds, and funds. And that single access point, we believe, is absolutely fundamental in tackling the fragmentation, which is still perceived as a weakness in Europe. So to give you a few examples, and Thierry mentioned one barrier that we face in Europe in terms of insolvency laws. But in the post-trade world, in the issuance world, we still have some persistent legal and fiscal barriers. So, for instance, you see differences in tax documentation, corporate action processes, settlement finality across all of the member states. And these differences can create a level of complexity that can be cumbersome for investors and businesses altogether. So we, as an infrastructure, we can alleviate some of these challenges. However, it would be good to work on smoothing them across the member states. So this is one of the conditions to be successful. And so that brings us to the digitalization. So we are, as we speak, very actively working on the development of our digital infrastructure to really embed digital securities within our core market infrastructure, rather than looking at running isolated pilots. We are driving today one of the largest digital use cases in Europe, which is the Digital New CP initiative, if you've heard of it, on which we are partnering with Banque de France. The new CP, short-term commercial papers, is a market worth more than 300 billion euros. And so that leading example shows you that when you align the regulator, when you align the technology, and you take a high market value, then you can unlock a very strong use case. But again, that use case must be supported by a very clear legal pathway that will allow the regulated players to keep innovating at scale while not replicating, and that's really important for digital assets, some of these barriers, legal barriers, that still fragment the traditional finance in Europe. Another thing on which we are looking at as an FMI, we increasingly deliver our products and solutions by acknowledging the fact that we need to deliver solutions that match client expectations closer by segment. Retail investors will have very different needs from institutional investors, wealth managers, or issuers, and therefore we need to cater for a level of differentiated infrastructure and product strategies to be successful rather than one-size-fits-all solution. So to conclude, our main goal is to remain a global connector between jurisdictions, between platforms and asset classes, and promote that interoperability across markets, technologies, and jurisdictions in Europe and beyond, assuring settlement finality through that neutral infrastructure.
Okay, thank you. I'm keeping an eye on the time because it's a big topic and a rich discussion. So before I ask the audience for potential question, I'd like to spend a little bit of time just exploring a little bit further the topics of retail participation and pension savings and how we mobilize those. So, John, you talked about it at the start. Greater retail participation is really what's needed here. So how can the SIU help? How can the SIU encourage that greater retail participation in capital markets?
Yeah, well, I think it's a centerpiece of the SIU. We're not going to get a capital market in the EU unless we mobilize those retail savings. And the very paradoxical thing is that some of them are already being mobilized into the capital market, but not in the EU. They're being mobilized into capital markets outside of the EU. But the job then is not to take all deposits out of the banking system, of course, but to take a percentage, and even a relatively small percentage of those deposits, bring them into the capital markets will have a big effect. I wouldn't want to underestimate the task involved getting retail to come out of the safety of the deposits and into a slightly more return but more risk in environment. How you do it? I think there's a few things. One is information, so they need to know what's available. They need to know how to use what's available and to understand. So it's a kind of a combination of financial education. And I use education in a wider sense than the kind of classical literacy discussion, because financial literacy is often seen as going into schools and teaching from a very young age. Unfortunately, we don't have 20 years to wait. So these people come out of school, and funnily enough, at least in my day, when you come out of school, you have no money. So it's very nice to be financially educated, but you don't have anything to invest. We need to move quickly towards the upper age groups who are perhaps not so aware, not so used to the market, but where the money is. And that means much more, less kind of classical literacy and more awareness, more informing people about what is available and how they can manage it. Then you need to make access easy. And that's where the savings and investment accounts, or ISA, Bob mentioned Commissioner Albuquerque, she's my boss, so I have only to agree with her that ISA is a good idea. But you want to make it easy to save. You want to almost create a sort of capital market account that's equivalent to a deposit account. You can put money in, you can take money out. It's just a different risk-reward trade-off. And then incentivization, of course, is very important in both directions. You need taxation to encourage people in, but you need to also inform people about their pension expectations so that they're not under the illusion that they don't need to save, because they will need to save. And I think if you put these three things together, information, easy access, and incentivization, then you have a chance. We, of course, in the SIU strategy, we issued this recommendation which was using best practice for savings and investment accounts. And that was based on a tour around Europe, including the UK, and also we went to the US, to check what had worked in terms of these instruments that are available, these vehicles that allow people to save. So the recommendation we made is really bringing together all the things that we thought worked. And what kind of works is kind of simple, easily accessible, tax incentivized, but not just in terms of rate, but also in terms of how you pay tax. Because what's a real disincentive around these vehicles is if it's complicated to pay your tax. If you can make it very simple, as in Sweden, you press a button and your tax returns are calculated for you. All that helps to make this a more attractive operation. So this is what we did. We went around Europe. We put together this savings investment account idea, which we've now sent to the member states. It's a recommendation in our world that's not as powerful as legislation. It's basically just asking the member states to think about something. We don't have a lot of competence, a lot of responsibility in the areas we need to. So we don't have a lot of responsibility in the area of pensions. We don't have a lot of responsibilities in the area of tax. So we can only recommend to member states what they do. But this has landed well, and a lot of member states are working on around the ideas that we have sent. Maybe just to say one thing, that we can't have any illusions here. I mean, Sweden are perhaps in the EU the most developed market, both in terms of their capital market, but also their retail participation. But this was done over 30 years. We don't have 30 years. So we need to sort of move a lot faster. So it's going to be difficult. It's going to be tough. But I think if you put these things together, it's more than doable, and particularly because investment has become easier through technology. You don't have to go to your bank anymore and sit for 2 hours while somebody tells you something. You can now access through your handheld device even. I have to touch on one other subject, which of course is value for money. You know, retail participants are not going to come into a market that doesn't give them value for money. So their net return has to be high enough to attract them in and keep them in, and to make sure that they tell their friends that they're doing well, so their friends also come in. It just takes one bad experience in a market to create a problem. And of course, the history of retail participation in the EU, at least, is not entirely positive in terms of returns. There have been high fees linked to commissions, no longer here in the UK, but still in EU. The problem, of course, is removing those commissions create problems with advice and availability of advice. So there's no simple solution here. I think the preference we have in the EU is not to regulate here, but to use competition, and to make sure that there is a sufficient number of simple, low-cost products available in the market to compete with what are more complex but also higher cost products. So rather than trying to regulate the market into one shape or another, I think the idea is to have as many products there as possible and let the retail investor decide which of those products he or she wants to use. I think if you put all that together, so if you add competition into my information, easy access, and incentivization, I think we probably have a recipe for success.
Recipe for success, no shortage of challenges and not a lot of time to execute on. But Vathani, maybe I'll ask you, do you think it's any easier on the pension side to mobilize pension savings to support EU economic growth?
So, I mean, I think a lot of what John said applies equally to pensions. It's just really a question of who you're asking to invest across it. But you know, one stat that really, in my mind, highlighted both the scale of the opportunity and the challenge was just quite how much is sitting in savings in the European Union, which was that there is about 13 trillion euro sitting in savings in the European Union at the moment. So the problem is not one of whether there is enough savings. There is no lack of savings. It's about that mobilization into investment, either directly or into pensions. And given we're sitting here in the UK, I thought it was just worth putting a few comparative points into that dialogue for people's benefits. And John touched on this point a little bit before, as did Thierry. The pensions landscape in the European Union is similar, but in some ways different to that we have here in the UK. So, for instance, only about 20% of European Union residents have a occupational pension, and less than 20% are invested in personal pension products. And if you put that together with, therefore, the heavy reliance on pay-as-you-go unfunded state pension, And some of the points that we've discussed earlier around some of the challenges that we face that make the SIU such a key critical driver of what's needed in Europe right now, it sort of starts to put it all into context, because you're in a situation where the pay-as-you-go part of the pension needs to be funded by growth and the population that is driving that, but we're in a situation where obviously the population is aging and growth is a challenge. So that unfunded pay-as-you-go piece is in and of itself something that needs the SIU to drive growth further in the economy more broadly. And then add to that the fact that we absolutely want our older people and our savers and pensioners in the years to come to have the ability to benefit from the greater returns that are available in other asset classes outside of savings. So that point on education and understanding is such an important one. So the first thing that I think that we would need to look at is really that point on participation in Europe. And that's slightly different, I guess, to what we have here in the UK, where the question is less around building the pools of capital. The pools of capital are here. In the UK, the question is much more around deployment. But in the EU, first we need to build them both in terms of being able to deploy them effectively into the economy, but also to enable our savers and pensioners to have better outcomes later on. That point on deployment is really an important one, and one that many in the room will be familiar with. And I think that's the second point, that why the incentives and the education is important, because if you want to really mobilize those pensions into productive assets, long-term assets, there needs to be a thesis around how you're going to deploy that way. In the UK, we've had that debate, and we've seen some of the accords that were touched on in the prior session. So in summary, look, I think we absolutely need to widen participation. I think we've got the point on improving allocation. And then the third point on trust, I think, is also equally true, and information, I think, as John put it, around making sure there's sufficient transparency and ability to understand what those savings alternatives are, so that the investment profile can match. Because the money's there, so it's really a question of finding the right opportunity to connect those groups, whether it be savers or future pensioners, with the economic outcomes that will suit them, but also drive the broader economy.
Okay, thank you. I think we are almost up on time. I'm just going to check if there are any questions from the audience.
I can't see any questions.
No? Okay. Any final comments from any of our panelists? Anything that, well, there's plenty we haven't had a chance to touch upon, but any final key thoughts?
Maybe one very quick thing, which is many of these things will take a lot of time to have an impact at scale. And one thing that could potentially, this is looking not so much at mobilizing savings, rather than accelerating the deployment of capital that is required, not necessarily equity capital, but securitization of banking assets would accelerate things much more swiftly in terms of creating more firepower to address short-term a number of the issues. Not all of them, but all of them. It's a regulatory thing, it's a political thing to some extent, but in principle, it is a lot faster, it should be a lot faster to solve. Unfortunately, the current package, as I understand it, under your control, is rather modest in its ambition still. If we compare that with what's happening in the US, but also in the UK, which has chosen to adopt an outcome-based approach, which is quite effective from that standpoint.
That is certainly a topic close to my heart, and I couldn't agree more on what you said, given my role at BNY. Well, thank you. I think it's pretty clear. We have a compelling agenda with the SIU. Making it a reality will really need action, coordination, ambition across public and private sector. I mean, our industry has a role to play.
so that we can together support the growth and the competitiveness agenda. And I hope to see further progress in the months and years ahead. Thank you.
Thank you.
Well, thanks again to the members of the panel for that very interesting conversation. We're now having a break. If everyone could be back in here at 4:15, please, so we can get going promptly at 4:20 for those online. Just to remind you, you can use the app for networking and to view the agenda, and also encourage you to fill in the questionnaires and feedback forms on the sessions you've heard so far. Thank you very much. See you back at 4:15. Good afternoon, everybody. Welcome back. Hope you did some good networking. The next panel is the explosive growth in private markets, opportunities and potential challenges. And we have to chair it Leon De Bono, who's the Managing Director for Industry Development at UK Private Capital, what we all know probably formally as the BVCA. So with that, let me hand over to Leon to chair the next session.
Thank you so much. And if I can invite my panelists to join. We have a very distinguished panel for this session, and also thank you for the invitation to speak. So we have Patrick Thompson, CEO of EMEA from JP Morgan Asset Management. We have Sandy Boss, Chair of BlackRock UK, and Rebecca Gibson, Managing Partner of Oakley Capital. And our title, as mentioned, is the explosive growth in private markets, opportunities and potential challenges. I won't ask everyone specifically to introduce themselves, and so we'll dive straight in. But as people start to ask questions, as the panelists answer questions, I will ask each of them to weave in a little introduction of their institution. But Rebecca, can we start with you, first of all, as managing partner of a GP, a private equity firm, very much focused on growth. The title talks about the explosive growth in private markets. Is that right? Can you outline your views on the growth of private markets? Where are we right now, and what are the drivers and current conditions behind that, and how are private equity firms adapting?
Yes, well, thank you for inviting me along today. And at Oakley, we are a pan-European mid-market investor. We were founded by an entrepreneur. So our typical deal is one where we're backing a founder of a business or an entrepreneur, and we're the first institutional capital in. So our own experience over the last decade, we've grown at 24% CAGR AUM growth over the past decade. Whether that's explosive or not, I don't know, but it's a pretty healthy, consistent return. And when you look at the private markets within Europe, I think I look back, it's grown about 2.5 times over the past decade. Beneath that, whilst private equity in the kind of controlled buyout environment which Oakley operates, you've also had an expansion of the asset class. So you've now got infrastructure, you've got private credit, and you've got areas like secondaries. So as it's become a much more mainstream part of an asset allocation strategy in the private market space, you've also seen emerging subsectors within it that provide slightly different profiles of growth and of liquidity, which has helped the whole asset class develop more broadly. As you look more recently, though, it's a more complicated picture than it might ascertain over the lots of longer trend. You had obviously a big dip in 2020 in COVID, and a quite remarkable bounce back in 2021 and early 22, with record levels both of new deal activity as well as the exits and realizations. And that, to some extent, then created some congestion in the market as typical investors who are used to a steady sort of 3 to 5 year drawdown profile of their capital when they make a commitment to a fund, that had suddenly been pulled forward very quickly. They had to invest a lot more than they were expecting, and then there weren't the same level of realizations. And so when we look at 2025, you've got a slightly different picture. It's been a more subdued market the past couple of years, but today, in the last year, you had a healthy growth at the top line, but actually focused more on the kind of the mega deals, the plus 10 billion euro deals, as the general deal activity was still down. So what that means for the asset class and where you're seeing performance is a much stronger focus on operational value creation. And it's absolutely fair to say that our industry benefited hugely from the low interest rates post GFC and a generally rising valuation market. And so it was relatively straightforward to make a nice healthy return with some relatively simple financial engineering. And those days are definitely gone. And so Bain & Company did a report last year, and they calculated that a typical company would have to grow 5% to deliver a 2.5 times return with a bit of leverage and looking at the market trends. Today, that's 12%. So investors into the private equity space in particular have to be incredibly focused on the particular GP that they're backing, looking for, a consistent investment strategy and really unpicking the drivers of those returns. Is it operational value creation? And do they have a consistent track record of actual realizations and distributions, the famous DPI metric? So for firms that can achieve that, you're seeing a bifurcation. Capital is flooding towards those GPs where you can demonstrate that long-term track record, where you can demonstrate you're giving your capital back to investors so they can reinvest in funds. So those kind of investors in that top quartile are doing extremely well, but it's certainly one where, as people go into it, it's really important to have transparency around performance and those long-term value creation strategies.
So that need for hands-on value creation is really key. Patrick, from JP Morgan Asset Management's view of the world, does that match does Rebecca's summary match your experience?
Yeah, I'd agree pretty much with Rebecca. Firstly, thank you very much for having me here. It's a great pleasure to share some thoughts and hopefully get some questions and dialogue going. So we're about $4.7 trillion of active managers. We only do active, and we've got a substantial, about $600 billion in what we call alternatives, which encompasses most of the private markets. And it's striking to us that the growth in private markets, so many companies are saying private for longer. The numbers really are quite staggering when you look at the market cap of some of the companies potentially coming to market this year. There's a couple of very well-known ones which have attracted a lot of attention. So, our view is that is going to continue. There are certain advantages to private capital that public markets might not always have. I totally take your point in terms of the top, selection bias around managers, really good GPs who know what they're doing, have got great track records. That does not necessarily confer an ability to manage money capital effectively through a cycle. Bearing in mind that we haven't seen a cycle really since, one could argue, 2008. We've had COVID, but so credit is getting a lot of attention at the moment, rightly in my view, because we have seen some changes in perhaps some of the strength of the underwriting across that asset class. So I think, again, it goes back to expertise around really determining what are the good credits, what are the not so good credits, how does that match in liquidity terms to the vehicle that you're trying to capture those returns in, and then who the end clients are for those. So that's a little bit of the question that I think the market is trying to digest. I don't think there's a systemic issue. I suspect we might get onto this a bit later, but I think there is great opportunity still for good managers to make, decent returns. And particularly it strikes us in a world where there's going to be more inflation. And if you take an asset class like infrastructure equity is perfectly suited to delivering a societal benefit. You think, whether it's the transition to renewables or energy or general infrastructure, and also capturing a rate of return that might, to a degree, protect you against inflation and that predictability. So, surprise, surprise, we've seen very substantial growth in our infrastructure equity business because it's trying to meet that need. I guess underpinning all of these things is this notion of liquidity, and how do you actually articulate that liquidity to end investors? And I think one of the things that we see, there has been explosive growth. I think McKinsey have a number of about 21 trillion in alternatives broadly put. So very, very substantial growth, become a core asset class for many institutions around the world. The question now is in the wealth space, which is growing fast, and because of the features of the underlying asset classes, those can be very attractive. But how do you solve for this issue around liquidity? How do you make sure that your underlying clients, who might not be as sophisticated as a pension fund or an endowment or an asset class consultant, how do they really understand that notion of liquidity? And I think you saw a little bit of that through some of the things that are happening in private credit. But fundamentally, we're very optimistic on its growth.
Yeah, and that liquidity question is a big theme right now. Before we come back to private credit, can I just ask Sandy, from BlackRock's perspective, what's your perspective on the growth of private markets?
Look, I think the story of optimism, I think explosion sounds negative. I think rapid growth and future rapid growth is definitely something that we see. So we actually have a company called Preqin, which does a lot of data analysis in the private markets area. They say 16 trillion of private markets today globally, so that's excluding some of the liquid alternatives. They expect to go to 26 trillion by 2030. And that's continued strength in private equity, the mega deals offsetting, some of the slowdown that is noted in some of the mid-cap areas where liquidity is a challenge. But very, very significant growth in infrastructure and in private credit. Infrastructure, we're in this once-in-a-generation moment where infrastructure needs are astoundingly large, and governments are at their worst position in, probably since World War II to actually complete those needs. And we're also seeing, it was mentioned in one of our earlier panels, companies are looking to diversify credit away from banks. Banks are incredibly important to them, but sometimes private credit can be more flexible. I think the right way to think about this is very much around the client demand. So taking a whole portfolio approach, we tend to start from that approach at BlackRock, looking at what are the client's investment objectives, looking at what's their risk appetite, what are their liquidity needs, what's the business model of that client. And when you do that, and you look across public markets, private markets, informed by a whole market set of data and analytics, you can actually very easily come to the conclusion that we are in a moment where the portfolio allocation of the future is not the one of the past. Anyone who's looked at a 60-40 portfolio lately, 60 equity, 40 debt, knows that that just isn't working. It's completely correlated. There's no diversification. We actually see a 50 equity, 30 debt, 20 private markets portfolio as being typical, and one that is suitable across asset classes, including, and I think the point, Patrick, that you're making about retailism is very important. We see that that kind of diversification is very valuable for smaller clients, but very importantly, in the right vehicles, with the right clarity around liquidity, and really making sure that one isn't overselling the diversification without really emphasizing liquidity, cost, complexity. Just finally, BlackRock, obviously a large global asset manager, 14.5 trillion or so in AUM. We now have about 675 billion in AUM for private markets, and that's because this has become an incredibly important strategic focus area for us. So in order to meet what our clients need, we bought Global Infrastructure Partners, historic opportunity in infrastructure, Global Infrastructure Partners, one of the leaders in the space. We bought HPS, leading private credit firm, so that we can provide private credit to our clients. We bought Preqin, as previously mentioned, dealing with this kind of legacy of intransparency in private markets. Unbelievably, they look at something like 230,000 different vehicles with tens of thousands of managers, tens of thousands of underlying investors, so they really can show you what's in that private market portfolio. And then obviously we continue to be an advisor to our clients around private equity liquidity. So we really see, going through the noise and some of the tactical issues, and I know I get a private credit question at some point soon. We actually see this as a very important area for our clients, and that's why the firm has made big investments.
Mm-hmm. And just to ask the private credit question, so many in the room, and Patrick has already been mentioned this, will be familiar with some of the recent headlines around private credit, the increased regulatory scrutiny. Sandy, what's your perspective on where that debate lies?
Sure, and I can look at it as an investor, but also as a former regulator. Look, the top line is what we see as credit investors. We see the market as constructive. We see credit quality remaining good. If you look at private credit, it's about $2.5 trillion. It's a relatively small part of overall lending, so it's about 6% of U.S. and European bank lending. So when you look at that, it's very easy to compare most private credit to, it's corporate lending, it's direct corporate lending to large caps and to SMEs. It's very similar to bank lending, very similar to syndicated loans.
What I think is really important here when we look at that financial stability question is thinking about the role that it's playing and also thinking about its relative size. So Bank of England, Financial Stability Board, they are asking the question about really two things. One is financial stability. Could private credit, quote unquote, do harm? But they also really care about credit availability and access through the cycle. So when I mentioned earlier kind of the size of private credit, it's relatively small. It is a diversifier. It increases the provision of credit into the corporate borrowing system. But importantly, it's coming from a source which is structurally less levered than banks. It's not regulated in the same way as banks, therefore not as quick twitch in the context of problems. And similarly, it's not backed by deposits. So there's no kind of, the run susceptibility that can exist in banking isn't really the same in most private credit when you look at the data of how most private credit is backed. So I think the important question is really, from a regulator's perspective, where's the kind of overlap of the ecosystem? And it is important to ask the question, how much private credit exposure is there in the banking system? Where have banks lent to private credit vehicles? Now, FSB has just published that that's 0.5% of all bank assets. That's a small number now, but they're doing further analysis, and as they should. From our perspective, this is a dispersion story. You were talking about manager selection, and in private credit, that is 100% what is required. So if you look the last 20 years, if you look at private credit IRRs versus comparable public credit IRRs, 14 out of 20 periods, the private credit outperform its comparable IRR. But that's a high-level number. You know, loss levels are about the same. Right now, what we're seeing in private credit is a return of private credit default rates to a historic norm of around 3.5%. It's been practically zero for quite some time. But remember, that's default rates, not losses. So default might be triggering a covenant that then allows legal right to the lender to be able to restructure. So what we actually think is important is looking at the manager dispersion. So you look over the last 7 years or so where there's data on vintages from sort of 2017 to 2023. And if you look at the median return, goes from a vintage might be 8% up to 11%. So pretty reasonable similarity of median return for each of those vintages. If you look at 2023 and you go interdecile, 4% is the bottom, and 21% is the high in terms of the return that a manager delivered. So we really think the key in private credit, like any other asset class, good manager, good quality of credit underwriting, good portfolio construction, being thoughtful about sector concentration, being thoughtful about how you are diversifying within the fund, not too concentrated of holds, and then very, very importantly, coming back to the point made earlier, ensuring that the investment horizon and expectations are matched by the liquidity of the underlying investor.
And to your point, just on the Bank of England, there's good engagement between the industry and the Bank of England as the stress test work continues. And just this afternoon, the UK Private Capital, so we're the trade body for private capital. A number of our members met with Nathaniel Benjamin, who's the Executive Director for Financial Stability, Strategy and Risk from the Bank of England, met today in Glasgow. And there's ongoing engagement. And actually our former chair, Matthew Savinclair, Senior Advisor to Cinven, was invited on to sit on the advisory group for the bank too. So very, very good engagement. And just coming back to Patrick, if I may, as the industry has grown, it is expected that it will attract scrutiny. Any sizable industry will attract scrutiny. The key is how the industry works with its stakeholders to shape the environment in which it operates. Patrick, I'm not sure if you want to comment a little bit more on private credit, but in which other ways might the industry attract scrutiny and continue to work with its stakeholders to shape the environment?
Sure. So just pick up on a point that Sally made. I mean, I work for a bank, and making a loan, there's no great art or science to making a loan. It's something that banks do. And I think being very, very forensic around those lending standards and making sure that there are a set of agreed standards that then don't lead to a series of unintended consequences, because you could easily paint a scenario where you've got rising interest rates, you have a cyclical slowdown, you've seen it a little bit in the software sector, but let's say you saw that in more broader sectors. Are the underwriting standards and is the diversification and portfolio constructions mitigating that risk to the extent that you should be rewarded for the excessive premium that you're getting over a loan? It's sort of that simple. So, you know, I won't beat that drum to death, but I think what's really important is working with the regulators here. So I was lucky enough to chair the Investment Association for 3 years, and we worked with Treasury policy makers and the FCA and the Economic Secretary to launch a thing called the Long-Term Asset Fund in the UK. And again, the intention here was to have a vehicle which would be broadly relevant for private or illiquid type assets and to make those available. And so we applaud that effort. And in Europe, of course, they've got the LTIF, and there's more and more demand from European and UK policymakers to have capital move into productive finance such that that can help economic growth. Again, all of these things are very laudable. I think, you know, back to my earlier comments, what's really important is that the capital that's supporting those investments really understands what it's investing in. And I think we tried to do that with the Long-Term Asset Fund, which is, you know, there's a certain sort of buyer that you want to make this available to. I would be concerned if you were able to get this daily on a sort of ETF platform for, you know, £1, shall we say. You know, that would not, I think, meet the original aspirations of the programme, which is to start to unlock some of this this capital from pools that, and Sandy's absolutely right, that, you know, that had traditionally been invested in 60-40 portfolios. So there is clearly an opportunity to do that. I think the next stage will be education around what are the underlying assets, what are the underlying managers doing, and why do they need these liquidity terms. So it's interesting to me that when there was these issues 3 or 4 months ago, everyone started talking about gates and how terrible it was. Well, a gate is there for a reason. A gate is there to protect other investors. It should be well disclosed in the documentation, and it serves a real purpose, which is to protect other investors in the fund who want to stay in the fund from you know, abnormal activity, should we say. So I think just education and understanding around these sorts of vehicles, what they're trying to do, and then also critically having a long-term view on the asset class, because, as I said earlier, you know, markets are at record high. And we haven't really had a cycle. And we do fundamentally at JP Morgan believe in an economic cycle. And when it manifests itself, you want to ensure that your portfolio is diversified enough to be able to attract and mitigate some of the risks that, you know, that those unintended consequences can lead to. Because I think the most pressing need for policymakers here, and we talked to the Treasury a lot, I was in the Treasury on Friday talking about this, is to unlock retail savings ultimately, to provide a better pension and retirement outcome for all of the citizens of the UK, and you heard in the previous panel, the Savings Investment Union, the same in Europe. And that is the most important goal, policy goal. And to the extent that alternatives can be part of that, that's great. But what you mustn't have is a retail saver that has a poor outcome on the basis of not understanding what they're invested in. And I think policymakers, quite rightly, are very fixed on that point.
And Rebecca, coming back to you, fundamentally the industry is supporting businesses, it's growing businesses, and as you mentioned, there's a lot of kind of value creation work that is involved in order to support those businesses, take them forwards for the future. From your perspective, is the industry well poised to contribute to global economies? And just picking up on that investor base point, should a broader range of investors have access to private markets, including DC pensions, which is very much a theme in the UK right now?
Yeah, and thank you for that. I think, you know, the BBC, as it was before, now UK Capital today, is been a really important gatherer of data to prove the positive attributes of the industry, where it's previously somewhat been in the shadows and seen as secretive and potentially not as productive. But you look at the metrics today, and it's very clear. 5% of employment in the EU is with private equity-owned companies. The employment growth in those companies is 4 times faster than other countries. The level of innovation and creativity is often much higher because you have an investor base that can think on the medium to longer term. And so there's many positive attributes that mean, from an economic perspective, it's really pleasing to see that the government is now much more positively engaged. How can the private equity industry help deliver the growth agenda that we know we all need and is desperately sought after both in the UK and on a wider European basis? So I think the argument and the data behind that is now very clear. So from an economic growth perspective, I think the private markets play a very positive element. And when you look at the long-term returns, there's been a significant outperformance of private equity against the public markets, notwithstanding a very recent strong public equity market that has made that less marked, but still on a longer-term basis, when you think about the diversification, there's absolutely a place for private markets to play within people's portfolio. And there are ways you can do that today. The listed funds market is available, whether it's of Oakley has a Oakley Capital Investments, it's a listed fund where any retail investor can buy shares in a collection of our portfolio funds. And the same with things like HG Capital. So there are ways to access it, but they have very relatively limited coverage and appetite. But what you have seen more recently is very strong growth into what people call the evergreen structures. So bringing retail wealth into the sort of private markets products. And at one point it was called semi-liquid, which I think is a really dangerous term because it's not liquid. And I think points that have been made about the liquidity and the gates are really valid. And therefore it plays part of a balanced portfolio construction. And one of the attractions of the industry, it is long-term. And you don't have the volatility of quarterly earnings and the kind of ups and downs of the cyclicality of the public equity markets that enable us to make longer-term investment decisions. We will often buy a company and invest in the operating platform, and at the moment AI, and we're very comfortable to do that and suppress profitability for several years, recognizing that longer-term payback. And that's much easier when you have a private shareholder compared to in a public equity environment. So I think the attractions of it as a sort of a medium term and having that benefit of longer-term investing is very valid. And I think you're going to see increasingly more avenues able to invest in it via these products. But it is about investor education and transparency, as you said, so that the right kind of investors are brought into it. And finally, on the sort of the DC pensions point, I think it's long overdue, the reform. I mean, it's absurd that the biggest investors are funds are pensioners in Canada and sovereign wealth funds in the Middle East and Australia. And yet the pensioners in the UK cannot access the kind of returns that we've been delivering to them over many years. So that reform, I think, is long overdue. We're already seeing it with the amalgamation of some of those funds into more concentrated teams where they can have the right level of expertise and the ability to have diversification over a larger pool of assets. So I think it's in everyone's interest to make sure that we keep with the communication, that we can make sure that remains accessible, because I think it will be very valuable to those investors in the longer term.
And Sandy, how do you continue to support access to private market investments for a wide range of clients?
Well, look, I think the exciting thing about right now is I think we have both the chicken of supply and the egg of demand. I mean, we have both sides working in private markets for retail or wealth clients as well as DC. Patrick talked about the LTIF and the LTAF. So our firm worked with others in the industry, with the regulators, to ensure that those structures could work. That also included more than one bite at the apple. It's taken time to get those fund structures right. We've spent a lot of time thinking about how to create our best offer for these types of clients. So when we have focused our evergreen efforts, we've got first of all, obviously, access to institutional quality private market strategies. That's something that these types of clients haven't been able to do before. We've emphasized multi-asset strategies. We actually think having a PM managing diversification is beneficial. We've also put a lot of thought into liquidity sleeves. So when we're selling an evergreen product with periodic dealing, what we're telling the client is you'll get the asset exposure, you'll get this multi-asset class exposure, but we might actually buy into an investment trust, a real estate investment trust, an infrastructure investment trust, possibly your investment trust, so that we're ensuring that there is more liquidity in the portfolio than merely a set of individual long-term investments. Valuation is critical, transparency of valuation, but then I think we've really invested a lot when we're working with, in particular, a wealth management firm who needs to then on-sell through advisors to end clients, focusing on content, focusing on education, enabling their staff, their employees to be able to provide the right kind of information. The demand is there. So wealth right now, if you look outside the high net worth and the ultra high net worth, holdings in private markets is sort of 2-3%, depending on where you look. It's very, very, very low. About a third of the biggest wealth managers in Europe now say they will have 20% in some kind of private markets allocation by 2030, in part because they're moving more towards centralized models. They have more discretion over their clients' portfolios, which means they can help with the asset selection as opposed to selling individual funds, where you have a much harder proposition for the end client to understand. In UKDC, we're very heartened by the fact that it is now happening. So the big master trusts, many of them are launching LTAF, some of them are growing. We've launched an LTAF that's been seeded by 2 UKDC pension funds. So we're starting now to see the demand, and there's an amazing fact. So apparently right now, the Pensions UK minimum requirement, like to have a decent life, we're only about 40% of DC savers apparently have the right trend to have enough in their DC pot to complement their state pension and have a minimum acceptable financial position. If you put private markets during the growth stage into a DC portfolio at a 10% allocation, the analysis that we've done, and it is pro forma, is that fund is 8% larger at the end of life. So you're really talking about a meaningful delta, and that's after fees, right? So I think now the focus on value for money and Mansion House has been incredibly important. Mm-hmm. That is a thing that is relevant here that none of us has spoken about. As these clients are accessing these private market strategies, particularly in DC, it is really important that the decisions that are being made are focused on net return after fee and not seeking the cheapest best product, because that doesn't work. And I have had on occasion discussions with UK investors in private markets who will say, we're not investing in the high-end fund because it's too expensive. We wait and we do co-invest with the funds that can't raise enough money. I'm like, is that the right way, So I do think there's a performance aspect to this that's incredibly critical, because, I mentioned that interdecile range on private credit. All private markets performance demonstrates wide dispersion. I mean, you see it in public equity as well. Very strong dispersion between the best performer and the worst performer. That is true here. This is an active asset class. It is lumpy, it is complicated to pick the right investments, to know how to get in, how to add value, how to exit. So anyway, I'm carrying on, but exciting.
And shifting topics slightly, and I'm conscious we're going to be running short of time, but we haven't yet mentioned AI. So perhaps can I ask Rebecca, first of all, how will AI advance private markets?
I mean, it's going to affect every aspect of what we do. We had an event a couple of days ago last week with all of our portfolio company managed CEOs and C-suite with a bunch of experts. We had people from Anthropic, from NVIDIA, and really trying to bring everyone together, because it's the number one question on our portfolio CEOs' lips is like, what do I do? Is it a threat? Is it an opportunity? How do I think about my business model? And for us as well, how should we be using it? If you think about the productivity improvements you can have, whether it's writing investment papers, we think about origination. We are mapping hundreds of companies across Europe, trying to find the perfect sweet spot of a founder-owned business in our core market, in our core sector, that we can help build value and work alongside them. I mean, the opportunities using AI are really exciting. So I feel it's going to be, there's a lot of noise. Every AGM you go to of a GP at the moment will be talking about what they're doing. At the moment, there's relatively few proof points. I mean, we've been looking at it since 2022. We've partnered with an American growth equity firm that's investing in AI and software businesses to get that kind of insight. And a lot of it's been, what are the areas that are most at risk and where are the areas of most opportunity? And I think that is a question that every GP needs to be asking. It's certainly not just about software. The SaaScopolis obviously had a big impact on the valuation of the big software players, and in private markets, there's still some questions as to has that fed through. But in reality, almost every company that you look at, whether it's about customer service, whether it's about financial accounting within your businesses, there's huge areas. So I think it's really exciting. I think it will favor firms that are willing to invest, as I said, looking for that medium term, because it's expensive, it's not free, and anyone who's started using Claude recognizes how quickly the tokens can be spent. So it's also about managing it in a structured way where the best value lies there. So I think it's very interesting, very exciting opportunities. Having metrics for success will be important. And I think we all need to be ready for a very exciting journey.
And Patrick, on that point, AI and or other innovations, what does the future?
Yeah, I mean, I think the private markets are ideally set up. I totally concur with what Rebecca was saying, that, companies that can be nimble and fast and invest. I mean, we're going to invest about $20 billion this year as a company on technology broadly put, and AI is a central part of that. So it is expensive, but we do it because we know that it will be a competitive advantage for us, given the amount of data that we have as a company. So it is central to, and it actually, it's a fantastic theme that can really help unlock a lot of value. So one of the areas that we're interested in is actually the transition between public and private. So we have a very large active public markets business. If you're evaluating companies in a certain sector, we've got analysts who've been covering these sectors for 30 years. They will also have a view on companies that want to go into those sectors that are private companies. And is there a way of capturing those insights and sharing them? Because this technology revolution is going to be, sector specific to an extent, but it is going to revolutionize so many of the activities of our underlying investments. So we are very much on the front foot. There are other obvious areas, defence and other themes that, yes, in terms of innovation and growth. And I think the UK, by the way, is an amazing place. We have challenges, as Sandy said, about, allocations from large DC pots, but we have an extraordinary ecosystem in life sciences, in defence, in innovation, the innovation economy. And I think really just marrying capital to those to generate growth and then productive growth of the economy, I think is a thing that, successive regimes, government regimes have been very focused on. The regulators, I think, have moved a long way to liberating that capital. So it's something that we totally endorse and support.
And Sandy, final word to you. Big changes in infrastructure too.
Sure. So infrastructure is sort of the enabler of everything, and governments need to invest in profoundly more infrastructure than they can afford. Banks are a big part of the solution, but private capital is a big part. A lot of it is AI-driven. So if we think about three big themes, there are others, but AI, energy transition, and also just transformation of demographics. In AI, briefly, data centers, it doesn't take a genius to figure out the incredible quantity of data center capacity that needs to be built to house the unbelievable quantity of new chips to deal with the compute that's required for cloud and for AI. So we think between now and 2030, it's about a 1.5 trillion, a lot of it in the US. And so, at BlackRock, we've raised our, AIP partnership, and it's an interesting fund where we've actually partnered with tech firms, so MGX, NVIDIA, AIX, Microsoft, or XAI, Microsoft, but then also financial capital, and we're also working with providers of energy, because actually powering those data centers will be critical. Building, especially in the US, it's possible to build behind the meter. That is a critical part of it. You look at energy transition. Here in Europe, we've been thinking a lot about the energy transition. How do we continue on the path of changing our energy mix, doing it in a way that is meeting European decarbonization goals, but also energy security, energy reliability, energy affordability in the context of Ukraine, Iran. These are really, really serious confluence of issues. And there, I think, we've tried to work at both ends of the market spectrum. So one, transition fund that will actually finance transformation of developed market infrastructure. But we've also done a public-private partnership with concessional capital, working with governments and philanthropies on climate resilience investments in emerging markets. So there's no end to the amount of financing required. We think it's 40 trillion between now and 2050 on the infrastructure part of the energy transition. And then just finally, we have a world that is growing profoundly. We've got aging countries, aging populations, where we need to do things like continue to mobilize and continue to restore infrastructure. So we've invested at GIP another $2.5 trillion. We've committed to bringing Gatwick second runway up and running. And it's an amazingly efficient way to put on 100,000 more flights a year. It'll be 14,000 permanent jobs with $2.5 billion. That's actually not much. So that's actually a really exciting investment that we're working on, and it will happen fast. But they've also, and I say God bless them, they've taken over management and partial ownership of the entire Malaysian airport system. So if you think that's a high-growth economy, it's 23 airports, hundreds and millions of routes every year. And so thinking about running all of these infrastructure opportunities, raising more money than governments have, but also helping build and operate infrastructure better, this is something that private capital can do in a way that it didn't used to be able to do before.
So on that note, and I'm conscious of time, growth in private markets, yes, with a real contribution and role to play. Will you join me in thanking the panelists? Thank you.
Thanks once again to that panel. I thought that was a very, very interesting conversation. We're moving on now to the last panel of the afternoon on transition finance. Worth just making a couple of remarks before we get going. So I was at COP in Belém in November, and it struck me that there's a sort of prevailing narrative around that green finance is in some way dead just because some politicians are not quite as supportive of it as their predecessors. Now, the truth of the matter is that the amount of lending in green finance goes up every year, and the amount of the percentage of the total finance that goes into adaptation rather than mitigation finance is also increasing every year. So do not fall for this narrative that green finance is dead. So to illustrate that and talk about it in detail, I'm going to introduce Linda Taylor, who is the head of international debt capital markets at Linklaters and works very closely in this area. And she has a fantastic panel. I'll hand over to Linda. Come up. Thanks so much.
Hello, last panel of the day. Stay with us. So here with me today, I've got Daniel Hanna, who's the Group Head of Sustainable and Transition Finance at Barclays. He's responsible for Barclays' own targets and also supporting Barclays' clients in relation to transition. He sits on various committees and teams within Barclays, including the Barclays Climate Ventures Investment Committee, which is investing in innovative and environmentally focused companies. Emma Harvey-Smith, who is a green finance specialist at the GFI, and she's responsible for unlocking growth opportunities and partnerships across the organisation. Her experience involves leading in the GFI's Built Environment Programme, which accelerated capital flows towards net zero and resilient homes. And last but not least, Chris Skidmore, who was the Energy Minister who signed net zero into law in 2019. He was chair of the UK Net Zero Review in 2023. More recently, he chaired the policy working group of the UK Transition Finance Council and sits on the UK Net Zero Council as co-chair of its Sector Transition Plan Working Group. And he's also chair of the Centre for Economic Transition Expertise. And I missed, and probably lots of other things beside. So welcome. We're here to discuss capital markets, the energy transition, and London's role as the global centre for transition finance. The world is continuing to move towards a low-carbon energy system. We need trillions of dollars of investment, as our last panel just said, in order to meet net zero targets by 2050. Governments have been making commitments, asset owners have been making pledges, so we're not here to discuss whether transition finance matters. That debate is now settled. But the gap between capital available and capital deployed to the real economy transition remains stubbornly wide. Why is capital not flowing at the speed and scale that the transition demands? What will it take to change that? And where does London fit into all of this? So we are going to navigate these questions today with our expert panellists, and perhaps, Emma, we can start with you. Maybe you could give us a temperature check on progress in transition finance and how the capital markets are feeding into that.
Yeah, of course. So transition finance, as our compere mentioned at the start, the finance is still flowing. If you look at Bloomberg New Energy Finance's latest view on the amount of capital that went towards the energy transition, 2.3 trillion, is it trillion? Yeah, $1 trillion must have gone towards the energy transition in the last year. So capital is still flowing. It's not flowing in a labelled sense anymore, or maybe we're seeing the evolution away from labels. You hear a lot in the news around organisations starting to green hush or maybe not shout about their sustainability actions as much, but we are still seeing action happen, and it's shown by the capital moving. So you asked, what's the role of capital markets in this? Well, the role of capital markets, they obviously play an important role. They can mobilise significant amount of capital. But the capital markets are most effective when risks are understood, when cash flows are steady, and when assets and portfolios have reached sufficient scale. And what we're really seeing in the transition finance market is that there is a bottleneck further upstream when you're looking at the actual pipeline of bankable projects. So when I mentioned that 2.3 trillion earlier, if you look at the sectors that money went into, it was all of the more proven transition sectors. It was going into renewable energy generation, into low carbon transport, into grids and other more proven, mature technologies that have clear cash flows. They have been sufficiently de-risked. They are safe and comfortable investments that generate returns. But we know that for the transition, we need to invest into some of the earlier stage sectors like sustainable aviation fuel, carbon dioxide removals, decarbonising buildings. And we're actually seeing that there are fundamental economic challenges that need to be addressed in those sectors, and the capital markets is not where we're going to do that. Putting a green or sustainable label onto a capital markets instrument is not going to make those technologies investable. We actually need to dig down into the economics, work out what the barriers are to investment flowing into those sectors in order to actually scale the transition and transition finance. So to bring this to life, if you look at sustainable aviation fuel production, which is going to be the key way that we decarbonise the aviation sector, it costs about £1 billion to develop a SAF or sustainable aviation fuel production facility, but it's really early stage unproven technology. So you end up with this challenge, which I think Daniel calls the missing middle, where you have a infrastructure style or size of investment needed, but the type of technology risk that venture cap are more comfortable with. So you end up with this challenge where these technologies can't be financed, and that's where you need innovative structures that are genuinely addressing the barriers to capital flowing. So why do I say all of this? It's because the capital markets really do have a role to play in those more mature technologies, but they are not going to be the be-all and end-all answer for some of the technologies that are absolutely vital for the transition. So we do have a wealth of capital moving into this space, but we need to work harder to make the projects bankable so that we can then start to scale them up through the capital markets.
So on the theme of labelled products, which you seem to be quite negative about, Emma, although they do have a role to play, we've seen a new move towards guidelines. So we've had guidelines coming from ICMA, guidelines coming from LMA about transition finance, There are also guidelines from the Transition Finance Council. So do you think, Daniel, that these are the type of initiatives that will unlock capital for the hard-to-abate sectors, or do you think it's going to be something more than that?
So guidelines matter enormously, but they're not enough. I think we wouldn't be having a panel here today if it was all solved by some guidelines, but they are very, very important. I mean, I think the work that ICMA has done, LMA has done, has been completely foundational in terms of how we've built sustainable finance and sustainable finance markets. And then the work that the Transition Finance Council has effectively built on that and has asked a slightly different question in some ways, which is, you know, not is this instrument green, but is the entity that we're referring to transitioning credibly. I think that's a really important set of components. And when you look at the surveys that we run, for example, with investors, 80% now say a transition plan is a very important input into their investment decisions. 69% of investors that we surveyed said that the number one priority within the sort of ESG sustainable finance space was transition strategies. So I think we are seeing that kind of importance and that convergence of standards, guidelines coming together and allowing the market then to put capital to work. But I completely agree with Emma, and it is not enough. I think the need for transition finance has arguably never been greater. I mean, I think the energy shock that we're seeing and that will linger for some time going through is going to lead to a spike in carbon-intensive activity. People are going to revert back to using what is available today to keep the lights on. But at the same time, it's increasing the medium-term benefits and ROI from switching to alternative power. So how do we credibly go through that transition, I think, is a really interesting question that we're all going to have to start navigating over the next 24 hours. On the previous 24 months, and 24 hours if you watch the markets. But I think equally we heard on the last panel about AI. I think there's like, what is a sustainable transition AI and data centers? These are exactly the types of questions that we're now trying to think through. What is the right standard principles that you can do that with? So I think that the need for transition finance is absolutely there. I think guidelines and standards are a very critical part to it, but they are not sufficient.
Chris, how do you assess the challenges of the gap between the capital available and the capital deployed in the transition? And on a more positive note, where do you see the opportunities coming out of London for the system-level financing that we need?
Well, I think to return to Emma's point around that sort of pipeline of projects that exists, you know, at a UK level, the Cities Climate Initiative, 3CI, I think sort of has a, you know, a £4 billion sort of pipeline that sort of only 10% is investable at this sort of current stage, and trying to understand, you know, some of these technologies, you know, whether it's carbon capture, SAF, you know, the role of government has been obviously to help sort of establish potential future sort of financing sort of frameworks, offtake agreements, but also to help sort of support the regionalisation of some of these strategies. You know, you think with the carbon capture or clusters in the sort of Humber or in Teesside, but that's only going to get sort of so far. Then, you know, the next stage is that challenge that 90% of obviously investment is in green finance or in transition finance. So, you know, the role for London here is the Transition Finance Council is sort of, I think, been twofold. What has been the sort of, you know, the guidelines that have been produced? How can we show London's international role potentially as a convener? And yeah, there's lots of, ICMA was mentioned, but yeah, other countries like Japan, South Korea, Saudi are interested in sort of being a hub themselves for transition finance. So I've always felt the challenge has been, how do we, you know, we don't want London to sort of race ahead and just be sort of, you know, come to London to invest, to make these investments. How do we collaborate and demonstrate that international sort of partnership model for the future? It's going to be interesting, you know, in this sort of shakedown around the guidelines. I've always personally, however, been interested in process. You know, when I was a politician, as a minister, you know, it's always great to have the best frameworks possible unless you've developed an effective process. And I think one of the big challenges has been, you know, we have now company transition plans that obviously have been led by, you know, a number of enlightened corporations that have sort of come forward. You think of like the Unilevers of this world, who sort of broke quite early, producing their sort of transition plans in, you know, UAE, I think, in COP28. But how does that link up with the sort of national strategies? And what's the national transition plan going to look like for aviation, and the role that's the SAF's going to play in that? You need to make sure that you have this umbrella mechanism, and that's where we've been taking work forwards, produced a finance playbook, because a lot of sector transition planning is happening, but they're not involving sort of finance and investors from the outset. And then we come back to this history repeating itself. I mentioned that 3CI pipeline project. You can have the best projects in the world, but unless you've really sort of sat down with financial community investors to understand what's the TRL level, what's the sort of the asset owner, asset manager, who's going to be financing at what particular stage, that work should have happened at the start. And so I'm sort of really interested now in sort of understanding when it comes to sector transition plans that we don't, history doesn't repeat itself, we don't make the mistakes, that we actually have this sort of, engineering, not reverse engineering, of actually having to put in place structures where the financial community, people like yourselves, actively engage and have ownership over these national sector transition plans. And that's something that the Net Zero Council is now going to be working on, because they hadn't had it in place. They were going to plan these sector transition plans, but without involving finance. And now finally we've got the stage where we're going to be actively involving financial communities. I think it's exciting. I still get that sort of sense that things are moving from high-level ambition. We all see this when we go to conferences, or we sort of people now are interested in the detail of how to make things happen. We don't need to state the obvious about what needs to happen. It's how do we make it happen, and that's the conversation I think we are now having properly.
So Emma, this ties in, I think, nicely with the themes in the GFI transactions to transitions approach, if I can say that properly. So could you talk us through that approach, how you see it working, and what practical interventions do you think that we need for all of that to move forward?
Yeah, of course. So building on what Chris was just saying, one of the breakdowns that we've seen within the financial and the net zero community is exactly the fact that finance is not brought in early enough into a number of these transition conversations. So you'll see these fantastic projects developed, you will see them just hasn't been. And we also see another breakdown, which is that governments are looking for sector-level transitions, and financial institutions, like those in the room, you're looking for individual transactions. And there's a real fundamental breakdown there. You can scale up individual amazing transactions. If you make these into repeatable models that can be done again and again and again, you can scale that up into a sector-level transition. But it needs to be done very deliberately in a very, very considered and actively brokered way. So to take this as an example, if you look at the built environment, we know that there is an ambition to decarbonise the built environment by 2050. There is a net zero policy and net zero ambition at a government level. And we know that there are pockets of excellence with particular green mortgages and various different solutions in the market. But it's not scaling up and happening at pace, because we don't have things like the right institutions in place that can help people to decarbonise their homes. We don't have the right demand signals in place. We don't have the right public capital in place that can allow these markets to scale up. So at the GFI, we developed our transactions to transitions methodology, which maps out all of the different steps that need to be taken at a sector level to get yourself from government ambition through to a thriving, scaling global asset class and market that is deploying capital at real pace into a sector. And again, it's all about actively making sure that we address the barriers and the challenges that we see in the market. Now, when you ask around some examples, so I talked there around an example in the built environment space, but I wanted to just add something around Chris's last question around London as a leading market. I think we have a huge amount of innovation happening in the UK, in London, in terms of sustainable finance, innovation and development. But I think there's also so many examples that we can draw on from emerging and developing economies as well. Some really interesting insurance models looking at markets that are really at the pointy end of climate change at the moment, that are really experiencing the real effects of a changing climate. And we've seen insurance and lenders innovate some very exciting models that could be scaled up. So London is a hub of innovation, but I don't think we should be hubristic. I think we should really look at exciting models that are happening overseas as well, and particularly, as I say, in emerging and developing economies where those models are going to be so relevant to us, but maybe in 5 or 10 years' time.
Interesting. So, Daniel, you have quite a global role, so you can see how this is happening across multiple jurisdictions, and obviously sitting within a bank, there's quite a lot of firepower there. So what role can banks have in this process? And what do you think would make it easier to accelerate their impact on the transition and on London's role in being a hub for finance?
I mean, I think we need to do three things on transition finance. I think we need to standardize, and we've talked a bit about that earlier on in terms of definitions. I think we then need to catalyze, and Emma was just talking a little bit about that. And then finally, I think we need to democratize. So if you just think about the standardization, we need to be speaking the same language. I think the work that Chris was talking about around transition plans, a national plan, how that feeds down into sector plans, really key so that investors, banks, other private sector investors can understand what the long-term plan is. Once you're clear on where we're going, finance then follows pretty quickly. And then there's an interesting tension around it. Is it very important not to leave finance to be the last thing? But equally, in some ways, we are the last bit of the puzzle. I mean, we need to know where the policy is going, what the intention is, both public and private investors, and then capital will find a way to deploy against that. And I think that's a really important tension around banks are not here to drive the transition. We are absolutely here to support whatever is laid out in terms of those policies. But this standardization, this ability to talk across all the same language across different pools of capital, I think is key. So if you look at our own client transition framework, we've now developed, which leverages, I think, 12 of the 15 Transition Finance Council's points. We've now covered the majority of our lending activity. We use AI to able to do it. And that allows us to look at all our client base on a consistent basis, which we then transparently share with our own shareholders. In terms of catalyzing, and this I think is really the critical piece, we're all after real world outcomes. And I think I agree with something that Emma said earlier, which is the labeled market, the labeled bonds play a very key role. Where we are now in the transition, I think we need more targeted capital that's really unlocking new sort of ways of doing that. So whether that is investing directly in early stage climate technology companies, we're investing 500 million into that, backing companies like Geopora, which is now the UK's largest producer of green hydrogen, or trying to come up with new tools. We launched a transition finance farming tool targeted at farmers in the UK, because I think, as we were talking earlier, I think the challenge of switching to more regenerative agricultural practices is a real one. And then at the other scale, we've been working with Brazil and a number of other sovereigns around something called the Tropical Forest Forever facility, which is trying to put 100 billion to work in forest preservation. So both at the sort of smaller scale with the individual farmers all the way up to the large scale, finance can absolutely play a role. And that catalytic piece, I think, is key. How do we drive real world outcomes, not just large numbers? And then coming back to this point around London, I think the key next step for all of us is how do we democratize this? I think large companies have access to transition finance. I think that sort of we're seeing a real deepening of that understanding. The big gaps now are more on the SME side and in emerging markets. I think on the SMEs, some estimates suggest that it accounts for up to 50% of the UK's emissions in terms of the entire supply chain. And we need to work out how do we get sort of transition solutions to them. And I think things like AI can play a really powerful piece. We've partnered with a company called Expect AI to try and see how you can create real profitable decarbonizing technologies at scale at the SME level. And then the other piece is emerging markets. I do think this is where transition finance particularly can help low to medium-sized economies as they transition their entire economies. And I think if London can help crack those two things, SMEs within the UK nexus and then emerging markets more broadly, that really will position us as the leading place for transition finance, which is going to be a significant driver in the next few years.
So Chris, big question for you. Can you summarize the opportunities, challenges and practical interventions that you see we need coming out of London so that London can take on this role as the global hub for transition finance that Daniel thinks we can see coming?
Well, I always believe that we sort of, what's the outcome we're seeking to achieve and sort of obviously work back from that as well. And, the net zero review I did in 2023, I think sort of articulated there was a sort of £1 trillion sort of inward investment sort of opportunity for the UK, and we should go for that. And these are the sort of 10 sort of missions that we should sort of set ourselves. And the government sort of took up some policies recommendations in the review, but didn't really grip that mission-based approach. And I still feel, on transition finance, yes, obviously this will be success will be delivered by the transactions that sort of come out, but what are we doing to baseline this so that we can actually effectively say, this is where we are, this is where we want to get to. And I think having a sort of understanding, we didn't manage to solve it in the Transition Finance Council in the first year. I think there's probably sort of work that still needs to be done on this. And one of the great things about the guidelines now, and Barclays coming on board to trial them, is I think you're sort of one of at least sort of, I think, 14 major corporates that have said they commit to this. We're looking to grow adoption of the guidelines, and actually, in a way, the ability for more organisations to potentially join this new coalition is potentially then we can actually understand what the baseline looks like of actually taking forward sort of the results, the tangible results. Because ultimately, that's what I'd love to be able to say is, okay, where are we now, 2026? What are we setting ourselves as a sort of North Star for 2030? At the moment, we're sort of not playing catch up, but it's still a sort of, how would I describe it? So we've been focusing on guidelines, we've been focusing on process. Let's make this a hugely exciting opportunity in the same way that the renewables sector and solar and batteries sort of get out there and sort of say, look, this is the learning cost of technology is coming down. This is the sort of speed at which you can deploy, and this is the economic opportunity. We sort of need that positive narrative for transition finance, rather than being a sort of, oh, this is a too difficult box, which it has been. In a way, you sort of end up it being a vicious cycle if you're not willing to get out there and make the positive case of what sort of potentially can happen. And we've seen it happen. I'm from Bristol. I was a member of Parliament down in Bristol, and sort of Amoresco coming in to sort of do the Bristol City Leap. That was £7 million worth of public finance that unlocked £450 million worth of private inward investment from Boston into Bristol. There's plenty of other opportunities if we get the frameworks right that we can have these success stories. So it is about selling success. And then with that comes that sort of virtuous sort of loop system that people want to be part of it. And that's where I think we can really sort of lead that in London, showing people this is not just something we're doing to help reduce emissions and recognising the critical role that turning brown to green or lighter brown is really important, and we've sort of missed that opportunity. It is about the sort of investment opportunities that come out of this once we now have the frameworks in place to be able to deliver it.
I'm conscious that we're running towards the end of our time here. I don't know if there's any questions that anyone would like to put to the panel. Not often you get a chance to ask these eminent practitioners. But if not, perhaps we can just talk about one thing we've discussed between ourselves earlier, which is around how can we encourage investors to engage with transition finance? What else can we do? And how can we sort of deal with the challenge of policy uncertainty here and across the globe? And how can we get public capital, as you were just saying, to sort of be engaged in the long term, because the transition is not a sort of 2-year investment, it's a much longer scale. So I don't know, Emma, if you'd like to take that first.
Yeah, I'll take the first part of that question around how do we engage investors on this topic. And I think it comes back to what most of us have been saying, which is we've got to step away from the tick box exercise and really show the economics of these investments, of these sectors, and the scale and the opportunity that they represent. So to bring that home with a really tangible example, we at the Green Finance Institute have been looking at, or have been developing a solution called property-linked finance for a few years now. It's a novel form of funding energy efficiency and resilience improvements in the real estate sector. The way we were able to get UK financial institutions, and we had NatWest and Lloyds work alongside us to develop a blueprint for how this product works, was to point to the US, where this is a $20 billion market and is one of the fastest growing private credit markets in the world. We were able to point to that, and that obviously made UK financial institutions sit up. We were then able to go and show that the potential size of this market in the UK was 150 billion, which again has now made the US investors who are familiar with this asset class sit up and go, oh, we might go and have a look at expanding our footprint outside of the US into the UK market. So it's really the sort of moral argument for sustainability and transition finance was never going to carry us all the way. There is a moral argument, but that's not, that's not what drives businesses. That's not what drives investors. We need to show that there is a case, there is an economic benefit, that there is scale, and that it merits you putting a lot of time and effort in to look at these markets, to look at these new innovations. So I think to those who are maybe from the more sustainability side of the market rather than the finance side of sustainable finance market, we can't talk in moral imperatives anymore. We've got to talk in finance language.
Chris?
Let me give it some thought. I caught me with a
Daniel?
surprise there. Sorry. And then I'll come back.
Yeah, sure. I mean, I think, first of all, maybe reframe your question a little bit. I think the UK has really led the way in a number of different ways. If you think about the CFD market, if you think about the innovation around the RAB-based funding for nuclear, for carbon capture, if you look more broadly at blended finance, I think one of the big unsung strengths of the UK ecosystem is I think we have led the way in deploying blended finance solutions, so mixing private and public capital into emerging markets. And I think we need to just take that expertise and insight and really start going at some of the stuff that Emma has talked about, which is you define a really clear transition finance problem, and you then try and create a scalable, replicable platform that does it at size. And I absolutely think that when you can present that as a thing, then investors will be interested because they are looking to deploy capital on it. I mean, last year, Barclays did the largest amount of sustainable finance we've ever done in 1 year. So this isn't something that's kind of, we're all navigating, obviously, the policy uncertainty, but there is large pools of capital, which if you can create the right solutions that can show the right impact, I think you can unlock.
I think just to come back to that point around solutions, what they say is the best way to predict the future is to shape it. And there is this window, I think, where institutions can either wait to see what might happen in government or might not happen. And we've seen that in the past, I think, with the EU, wait and see. It isn't always necessarily a great solution because then it destabilizes longer-term policy solutions because they're not necessarily the right fit. And then get some institutions that find themselves having taken decisions that then they're led, but actually the politicians are playing catch up, or there's been reverse ferrets. And now, actually, I think particularly in the UK, particularly in London, particularly in that context where we're going for the future of sustainability, we are moving away from that position around acronyms and accounting, and to this active involvement of the finance sector. And organisations like Barclays have led by getting involved. And there is still that chance, both on the sector transition pathways that are being developed in the UK to be involved. We had our first, actually NatWest hosted the last meeting we had last week. So if there's particular sectors that you are focusing on, look to see how you can help influence those sector plans. And then I think also with the Transition Finance Council, it's not for me to necessarily speak on this, but on the guidelines, there is a huge opportunity to be involved, to be one of those pioneers in helping to test them, because this is iterative, isn't it? We don't want to claim that we have all the solutions on day one. What we need to create are these positive feedback loops, what we call like an active co-creation, where we can actually test what is working, understand what's not working, and feed it back into the policy process. And you're practitioners, you can help make that happen. So don't just wait for policies to come down the track, which then you have to implement grudgingly. Be involved in actually actively helping to shape it, because you'll be surprised actually. People want, policymakers, both in government or in Corporation of London, are wanting to have your expertise in the room.
So, I think it's really interesting. It's such a shift away from the discussions we were having a few years ago around very specific products with very specific uses of proceeds. The realization has come that this is a much broader challenge. We have to approach it in a very different way, and the transition will require everybody engaging, but it needs to make business sense, and we need to make the business case, because the moral case is not necessarily getting the capital flowing, but the business case certainly will. So London's very well placed to do that, and I think we've got lots to be optimistic about. So with that, I will say thank you to my panellists, thank you to all of you, and I'll hand over to our hosts.
Well, thanks everybody. Thanks for that great panel. I think we've had some fascinating panels this afternoon. I've actually learned a lot myself. I've really enjoyed it. Can I just ask, is Daisy in the room from Invest Hong Kong? Doesn't look like it. So I'm just going to wrap up. First of all, say thank you to those attending online. Thank you again to everyone in the room. Here's Daisy now. Thank you to everybody in the room, to our delegates, our speakers, sponsors and partners. I'm just going to briefly introduce your host for drinks next door, Daisy Ip, who is a seasoned professional with a wealth of experience in driving economic growth and powering international trade, currently with Invest Hong Kong, who are sponsoring this event. So Daisy, welcome to the stage.
Thank you, Chairman, and good evening, ladies and gentlemen. It's great to join you all today to see so many industry leaders, friends and partners from the international finance community gather here at the City Week today in London. I am Daisy Yip, the Head of Investment Promotion of Invest Hong Kong, London office. So for people here who don't know who we are and what we do, Invest Hong Kong is the investment promotion arm of the Hong Kong Special Administrative Region Government. Our mission is very clear and simple. That is to promote two-way investment and business opportunities between Hong Kong and the rest of the world. So in today's global environment shaped by uncertainty, geopolitical shift, and technological advancements, Hong Kong's status as an international financial center has never been more relevant. Hong Kong continues to offer what global markets value the most: openness, connectivity, our rule of law, our regulatory environment, free flow of capital, talents and informations, and also deep capital markets. So Hong Kong is also uniquely positioned ourselves with the advantage from the global investors and also China advantage. We're creating a platform and also a gateway for international investors to tap into the business and investment opportunities in the high growth region in Asia. So for Hong Kong, we are not just maintaining our leadership, we are also shaping the future of finance, especially in the area of green and sustainable finance. In fact, I'm not sure if you know that Hong Kong ranks #1 in Asia for green debt issuance, including green bond and green loan. This reflects the international confidence in Hong Kong's financial markets and regulations, and also the strong markets. And also the Hong Kong cross-agency steering group also have set a very, very clear priorities for the next few years for Hong Kong, including maintaining Hong Kong as a leading green and sustainable finance center in Asia, also advancing our ISSB-aligned sustainability disclosure standard, and expanding the transition finance through the Hong Kong Taxonomy Phase 2A. So at the same time, the government is also continue to support the market development through direct initiatives such as Sustainable and Green Finance Grant Scheme, offering of up to £250,000 for issuing green bond and digital green bond issuance cost. So this is very, very particularly exciting today, that we are also seeing the trend and the convergence of digital finance, digital asset, green finance, and also green finance, digital asset, and fintech. So Hong Kong government is also putting a lot of effort in promoting this trend. In fact, the Hong Kong Special Administrative Government has issued the first ever in the world government tokenized green bond. And building on these foundations, we have issued the world's largest tokenized government green bond with multi-currency offering of £1 billion. So meanwhile, the Hong Kong's border digital asset ecosystem is also growing rapidly. As of last year, by the end of last year, banks in Hong Kong held around £1.4 billion digital asset under custody, and also tokenized deposit has reached £2.9 billion. So initiatives such as the Project Ensembles led by the Hong Kong Monetary Authority is creating a platform, infrastructures for digital asset and carbon markets, transforming the real-world green infrastructure projects into investable digital green assets for international investments. So ladies and gentlemen, I'm going to stop here because I just want to tell you that Hong Kong is very committed in continuing our status as an international financial center, as well as a strong, sustainable, green and digital finance in Asia. So feel free to talk to myself or also my team here today if you have any information or if you want to share anything that your plan in Asia or in Hong Kong. But thanks again for having us today at the City Week, and I hope that you will find the event very, very fruitful and also informative. Thank you.
Thank you, Daisy. And that presentation brings day one of City Week to an end. We very much look forward to seeing you tomorrow if you're attending day 2 of City Week with the morning summit on tokenization and digital assets, and in the afternoon, AI. In the meantime, we wish you a very safe journey home, and we look forward to seeing you at another City and Financial event in due course. But in the meantime, do enjoy a drink. Thank you.